Okay, I will say hello and welcome back to another episode of All About Balance. And today I am joined by the infamous
Infamous.
R/ deep fucking value. Josh, how's it going?
I'm very well, thank you. How you doing?
I'm all right, mate. Yeah. um, yeah. So, how does it feel to be deep fucking value?
Well, I've been hiding it all this time. I had to get a fake person to do the
Yes.
Congress stuff for me, but
Yes. So I probably should preface this with who deep fucking value is. Um, where do I even start? So, for people that follow memes, I guess in general, you will have come across WallStreetBets, the Reddit subreddit on. I mean, what? How do you even at this point? How do you define WallStreetBets? How would you even define WallStreetBets?
good question. It's a what I don't even know. I'm not very good on Reddit, to be honest. It's
Yeah,
a
me
Reddit. What do
neither.
you call it? A group? A group on
I don't
Reddit?
know,
A
mate.
page on Reddit?
A
There's a
cult
page on
on
Reddit
Reddit.
that cult on Reddit. It's a page on Reddit that focuses on finance, skewing more towards the I'd say risky side of things.
Yeah.
It's much more about, and I bear in mind I don't really spend much or any time on WallStBets, but I think a lot of it's about individual trade ideas as opposed to investment philosophy as a general theme, so to speak.
Yeah, I think that's probably a
Uh,
good definition. What happened, however, on WallStreetBets is, and this is, and I think this is probably one of the things that I'd like to delve into the deepest is so some guys on WallStreetBets had found that there were some companies that had been incredibly overshorted, and we'll get into what shorting is in a second. But what they decided to do is not form an organization, obviously, because that would be illegal, but they decided to offer the opportunity to bet against the shorts on said company by buying stocks. And what that turned into is AMC, GME, Diamond Hands, Moon Travel, and a variety of other things. Um, as a man that has a lot of experience in.
or some experience,
All
perhaps.
right, fair
Yeah.
enough. You could downplay
Yes.
yourself if you wish. Shall we start with what is shorting and what is betting long?
Yes. Yeah. So would it be fair to say that people understand what a stock is to start with?
Okay, well, all right, let's actually do that then. Let's do that. Let's do
Okay.
that.
So
So what is a stock?
a stock is a part ownership of a company.
Yeah.
So a company will have a number of shares outstanding. Each one of those shares has a particular value. If you multiply the value of a stock by the number of shares outstanding, you get the value of the company or the market cap of the company.
Mm-hmm.
So when you own a share, you own a very, very small part of a business. Shares can be any price. They can be split. So you say you might do a 5-to-1 split, where if you own one share, you then get 5. That happens particularly often if shares increase in value a lot, like Tesla, for example, where it becomes difficult to buy one share because each share is, say, $3,000, for example. You might want to do a split to get the share price lower. So a normal person with a month's wages could buy a share, for example. And generally, with stocks, people tend to buy them, i.e. own them long, so to speak, which is that they think the price will go up. So they take a positive view on the company and they buy the shares for that purpose.
So just to put that into layman's terms. So
Yes.
if you want to what's called buy long on a stock, what you're betting is that the company value will go up, it will appreciate, the company will do well, they will expand, they will earn more revenue, etc., etc.
Exactly. And everyone's incentivized for that to be the case. The government. So it tends to, that tends to happen. People going to work every day, if they produce more than they cost, then you'd expect the value of companies in general to increase, as long as you believe that is true. I suppose it gets very much more complicated than that, but very generally, if capitalism is working, share prices as a whole will increase.
Yes.
What is it? Rising tide lifts all boats or ships or something.
Some shit like that, yeah.
Yes. Okay. But if you have the exact opposite opinion and you think that the share price will go down, or importantly, you have to hedge yourself or cover yourself against the risk that the share price might go down.
Mm-hmm.
So you might be exposed in some way to the share price going up. there are a number of things that could lead to that, which we might want to go into later, I suppose.
Yeah.
You can short a company. And what that means is you, through the medium of your broker, often you'll ask them to borrow a share. The broker will then go and find the share from someone who owns the stock. They'll borrow it from them, lend it to you. You then sell it into the market, get some cash, if that makes sense. So the person that you borrowed it from, provided a service by lending the share. So they get a borrow fee. So you have to pay a borrow fee to short a share. And you also have to pay any dividends that are paid on the stock, for example. Mm-hmm. And the person that lent the share, i.e. the person that owned it, that's allowed it to be borrowed, brokers will often split the borrow fee depending on who the broker is. Sometimes they won't. If they're really, really low fee brokers, I don't think they do it, but often they'll split the borrow fee between the broker and the person who lent the share. And I might be wrong here, but the only problem with lending out shares is that you can't vote the shares.
Right.
And for most people, that's irrelevant.
Really. Again, just to confirm, for layman's terms, what is it when you say vote the share? What does that mean?
Say there's it happened today with one of the companies I own some shares in. There was an acquisition of a company I owned some shares in, and the offered price was only 1% above the price that the shares were trading at. Mm-hmm. So most of the people thought that this was a pretty terrible acquisition offer. They thought the company was worth a lot more. So a bunch of reasonably, small but somewhat significant shareholders got together and asked people to register their shares as, against the acquisition, which I did. And then as a result, the acquisition offer got increased something like 17% today.
Right.
And when the acquisition actually happens, we'll be asked to vote on the acquisition.
Yeah.
And I will vote probably for it now, but I would have voted against it before.
Right. So essentially, again, in layman's terms, what this means from a regular person's perspective is because you own a small portion of that company, you then have a say in that company, right? So you're almost acting as if you're on the board. A really good example of this is Barcelona Football Club, right? Mm-hmm. So Barcelona Football Club is almost entirely fan owned. The board is run by a conglomerate group that represents the fans, but that conglomerate group isn't a business. They are fan owned. So all of the decisions that are made, or predominantly all of the decisions that are made in that football club, are fan made decisions. So that's just I guess to sort of put that in layman's terms. And again, to put into layman's terms, the shorting of stocks, essentially what you're doing is you're betting, for whatever reason, that the stock will depreciate, the company will do worse, the value of the company will go lower. Now,
exactly.
Just to round off this current sort of preface before we get into the conversation is, could you determine the difference between a share and a stock?
They're the same thing.
Right, fine.
They're synonymous.
Good. So that's fine. It's just because when we use the terms, like I understand that they're the same because of all the conversations we've had, but it's good to determine that when we say share and stock, that they are the same thing.
Yes. I will accidentally use lots of jargon, so it's very helpful that you...
That's fine. I will happily pull you up as a non-finance person to determine what jargon is and what jargon isn't. So if you'd like to explain what happened with GME, AMC and Nokia and the rest of them in as much detail as you want.
I'll do my best. So when you short a share, as we said, you essentially borrow the share from someone that owned it and then sell it into the market. Mm-hmm. So when that happens, you have in existence 3 shares, right? One is or 3 exposures, I should say. Mm-hmm. One is the person who actually owns the share long, the original person. Mm-hmm. Then you have the person that sold the share short, and their exposure is that at some point in the future, they have to buy back the share and give it to the person they borrowed it from, mm-hmm. right? And then you have the person that bought the share from the person who sold it short. Does that make sense? Was
yes,
that clear?
Absolutely. Yeah,
yeah.
Absolutely.
So you've got three exposures, 2 long and 1 short, mm-hmm. right? So at any point in time, the difference between the number of people holding the shares long and short will always be 100%, or all the shares outstanding, right? Mm-hmm. So in this case, 1. So you can hold a company, more than 100% of the shares of the company can be held short. Mm-hmm. That makes sense. As long as, and it will always be the case, the difference is all of the shares. You can be 101% long, 1% short, 100% long, 0% short, 200% long, 100% short, whatever, right?
Mm-hmm.
At some point, and I don't know the exact figures on the number of people that were holding the shares short in GameStop, but it got really, really, really high at a certain point. And some enterprising fellow on Reddit, or someone on Reddit, pointed this out and basically said that this company is ripe for what's called a short squeeze. And the reason that it's important to understand the mechanics of how shorting works is because to understand how a short squeeze works, you have to understand the sort of how people get themselves stuck. Mm-hmm. So if loads and loads of people hold the shares short and the shares start increasing in value, the people who own the shares short have to at some point be able to buy back the stock in the market and give it to the person they borrowed it from, right? And they have to be able to prove at all times that they can do this. They're capable of doing that trade, right? So at the start of the trade, they might just have the cash they had from selling the share in the first place. Mm-hmm. But please stop me if I'm going too fast or not.
Oh, no, you're about to get to the really important part of this whole story.
Yeah, so you basically have to prove that you have enough money to buy back the amount you sold in the first place at all times.
Yeah, and this I think is something that we should start to cover. So yeah, especially what happened with WallStreetBets. So the shorting was done en masse by hedge funds, right? And we'll get into what a hedge fund is after, but they're done
and individuals.
Yes,
it's
absolutely.
important to understand that lots of people were selling shares short.
Yes,
and in fact, I think just before we go into that, it's worth pointing out that there's a genuine reason why people were selling GameStop short. GameStop, I think most people will agree, is a pretty mediocre company. Yeah. Now that might change in future, but at this point in time, all evidence suggests that game sales are going overwhelmingly digital, and especially during the pandemic, they're even more so going overwhelmingly digital. GameStop has been declining for years, and its decline was accelerated in the past year because of the pandemic. So
and I think again, just to clarify what GameStop even is, because we didn't even do that. GameStop essentially is basically like a Blockbuster or a game or whatever, a game station, whatever it is. You go there, you buy a physical disc with a game on it, and that's what GameStop is in America.
Yeah, exactly.
So yeah, sorry. So it was declining vastly, and the reason why I mentioned hedge funds is because when we specifically were looking at the company records, you could see that en masse, it was hedge funds that held the most amount of shorting. Now, why it's important that they can cover their position is because, and the reason why this thing sort of happened is that people drove the stocks up so drastically that the hedge funds had to prove that they had capital to cover their positions. And what cover their positions means in layman's terms is that you can prove that you can buy back the stock at a price that a percentage of the price, the stock that the stock currently is, right? The value of the current stock.
Yeah. So say I shorted an apple, right? A single apple.
Yeah.
Right.
Oh, right. A single apple, right?
Yeah. So you own the apple, right?
I do. Yeah.
I borrow the apple from you.
Yeah.
And I sell the apple for £1.
Yes.
Right. And I have £1, and at some point in the future, I have to buy back an apple.
Yes.
If the apple goes up to £2 in price,
yeah,
as far as my broker is aware, I'm unable to buy the apple, right?
Yeah.
So they will close out my position, and in fact, they'll close it out long before it gets to £2, right?
Yes.
So what I have to do to prove that I can buy the apple back at some point in the future, I have to keep putting cash into my account.
Yeah, all that 10 pence is loads of them.
So I have to put in 10 pence until I've got £2 in my account and the apple's at £2. If the apple goes up to £4, I have to keep putting more money in to prove that I'm capable of buying back the apple, right?
Yeah.
What happened in this case is GameStop went from like $15 a share to at one point $450 a share. Yeah. So you can imagine how much capital all of these hedge funds were having to put in to maintain the position. And the problem is, and would you like me to progress the story a little bit further?
I would, but before we get there, I just want to say that what we mean by closing your position is releasing your stock, your ownership of the stock, whether that be short or long. So if you've shorted a stock, you must sell the stock back into the stock market, or back to the person that owned it long. And if you own a stock long, you are selling the stock at the price at which the stock is. That's what closing your position is. So the broker, if Josh had got my Apple sold short, fuck you for selling my Apple short, by the way, because my Apple is definitely going to appreciate. If my Apple appreciates to £2 and the broker is determining that Josh does not have the funds to cover that, they will sell his stock, or they will sell his shorting automatically so that he doesn't go bankrupt.
They'll issue what's called a margin call.
Yes.
Which is basically saying put more money in or we'll close your position. And they'll do that before the value of the Apple reaches the amount of collateral they have.
Mm-hmm.
Yeah. So yes, they basically say post more margin into your portfolio to show that you're capable of closing out your position or buying back the stock, or Apple in this case, or will close out your position, because the broker doesn't want to be on the hook for your inability to pay.
Right.
So what happens, the problem obviously in this case is that the process of closing out your position when you're short is to buy the stock, right? Mm-hmm. And buying something creates demand for it. More demand equals higher price, mm-hmm. right? So what happens in a short squeeze is that all of the people who are holding the stock short are getting close to their margin calls. So they're all having to buy the stock back in the market to close out their positions, which in turn drives the stock higher, which means that the people who haven't sold have to post more margin, which means that they're essentially going to go insolvent, which means they have to buy back the stock, so on, to the moon, as they were saying.
Literally to the moon.
Yeah, and it's theoretically infinite, right? As long as people aren't willing to sell their shares, the price just keeps going up.
As long as they also keep buying shares. It's not just a static position of just holding the ones that they've got, right?
Well, yes, someone has to be buying to create new price. Yes, trades have to be happening to keep pushing up the price. Yes. But what can happen is that you can trade, there might be 1 million GameStop shares outstanding and 10 can trade. Yeah. But if 10 shares are trading hands at $600, the market price is $600.
Yes.
So even if it's only a tiny amount of the float that's trading, whatever defines the price is what causes.
So I'm going to stop you there because I think there's another definition to make. Can you determine what the float is for people that don't know?
It's the amount of shares there are outstanding.
Exactly. Yes, exactly. And what outstanding, again, just to make this super clear, because this is kind of the point, is what outstanding means is somebody hasn't bought it long and they haven't shorted it yet. So it's available. It's available to
they'll own it, right?
Yes.
So some they will have bought them. It's the number of shares there are. So people will own the shares. Someone has to own them, right?
Right.
And people shorting won't affect the number of shares outstanding.
Sure.
It can create artificial shares, so to speak. But the number of shares outstanding, unless the company issues more shares,
right,
will remain the same, or splits, so doubles the amount of shares. Yeah, or so. But yes, it's the number of shares outstanding. So the value of one share times the number of shares outstanding is equal to the value of the company.
Yeah, and that's where we talk about especially with GME, and I don't want to derail this too often because we'll carry on with the story, but with GME specifically, they had an operating profit and then what the company was actually worth, which was incredible amounts times, right?
Yes, yeah, the value of the company got quite wildly out of hand.
Yes,
as it went
multiple
higher.
Billions.
Yeah,
which is nuts.
So essentially it's a lot more complicated than that because of options, and I don't know if you really want to get into options.
I think
it's another level of complexity, but
yes,
essentially options are a way of having a very leveraged position on a stock without putting in a lot of money. And the problem is obviously that if the stock doesn't move as much as you think it will, your option expires worthless. A share won't expire worthless. It could become worthless if the company goes bankrupt in future, but you own a share forever, unless whereas we're not generally have say a 3 month, a 6 month, a 9 month period of time. But essentially, people buying options caused people to buy even more shares, which created the problem. Caused the problem to get even more exacerbated and so on.
Yeah, and I think that's a really good starting position. However, I want to just detail what happened to some of both of the Redditors, right? And or what we call the retail investors, right? And what happened to the hedge funds.
Yes.
So should we start by just determining what a hedge fund is?
Yes. So do you want me to
Feel free, feel free.
So a hedge fund, generally you have things like mutual funds, which are what people will put, say, their pensions in, and people now put their pensions in hedge funds, but mutual funds tend to be long only, i.e. they're only allowed to buy stock positions. And mutual funds used to be very common. Now a lot of people put their money in ETFs instead, which are, there's a difference, just a very quick segue, actively managed versus passively managed. So actively managed is when there's a person or nowadays an algorithm that makes decisions, and I guess a bit iffy with algorithms, I suppose. But essentially you're paying someone to make investment decisions for you. And passively managed is when they just do, when they invest based on a predefined decision-making like rule book. For example, an index is the biggest 500 companies in the country, something like that, the S&P. And people who replicate the S&P index in an ETF basically say, what we will return the same performance as the S&P. And therefore they can charge a very low fee because no one has to make intelligent decisions. They just have to make operational decisions. It's actually quite complicated to replicate the performance of the S&P.
Well, of course.
And doing it as cheaply as possible and so on. But it's cheaper than paying a bunch of people a lot of money to make investment decisions. So anyway, segue over. Mutual funds tended to be long only, so they just buy stocks, whereas hedge funds can go long and short. This is a wildly overly simplistic explanation, but hedge funds, hence the name hedge funds, can take offsetting positions. So they can say, go long some stocks and short other stocks. And this was, this is basically based on the idea that, and what a lot of funds will do is they'll take an index, say the S&P, and they'll buy more of the companies they think are the best companies and the best value companies in the index, and they'll short the companies they think are the worst value companies in the index. And long short equity funds did very well, I think, in the tech. I don't know if you remember, if you have read about the tech bubble in the sort of late 1999, 2000 kind of time, .com bubble, because it was really obvious that some of these companies were just, fake crap companies. So they people would short them and buy actually decent companies.
Like Microsoft or some shit, or IBM or whatever.
Although Microsoft got caught up in the, I think what was it, like 10 years before Microsoft became as valuable as it was at the peak of the .com bubble.
So in terms of what happened to the hedge funds, specifically with GME, I should probably just preface this. What I was going to preface: the retail investor is essentially somebody that's not an organization. So yourself, yourself, myself, anyone that logs onto an app or goes through a broker and says, I would like to buy a stock of whatever, who cares, right? You are a retail investor. Retail being that you're not a consortium, you're not an organization, you don't operate based under some form of legislatory, a position that somebody sets you, other than the FCA, I guess. Maybe, depending on who you are. Now, what happened because of the short squeeze that the Redditors initiated was that some of these hedge funds, predominantly, was Melvin Capital, right?
They were the most famous.
Melvin Capital went bankrupt, and if you could explain why they went bankrupt.
Well, they didn't go bankrupt. Melvin Capital is still active. They just lost a lot of money on this one trade.
Didn't somebody buy Melvin Capital though? Because it was that dude that bought.
They took So Melvin Capital. I can't remember the person's name.
Yeah, I can't remember him either.
Actually, he ironically, given all the sort of stick that Melvin Capital and hedge funds got in general, the person who runs Melvin Capital seems like a really, really good guy. He seems just like a lovely guy who's really good at investing. Wasn't particularly rich. He didn't come from a really rich family. He's just really smart, really genuinely lovely person. But
got fucking shafted.
Well, he did, but he also did very, very well for the previous few years. So anyway, But he used to work, I think, at, I don't know what they're called. Is it SAC? There's a guy called Steve Cohen. I think there's a
that
shop
guy.
called, is it called Black Edge? Something like that, Black Edge. It's about the show Billions. You know the TV show Billions?
I've heard of it. I've not watched it.
That's about Steve Cohen,
Right.
loosely based on Steve Cohen. I think the guy who runs Melbourne Capital used to, and I might be, check this, don't take it for granted.
Sure.
Used to work at SAC and then left to start up his own fund. So his fund had a big investment from SAC. And I think when things started to turn south, Citadel, who were very heavily involved in this sort of story for multiple reasons, and SAC, I believe, I'm not sure if there are other people involved, put a large amount of capital into Melbourne Capital, I think about $2 billion or something.
Yeah.
To help them with their, get out of their position.
Yeah, and the reason why they were in such a position because they shorted GME so hard, and because the price of the stock had risen so much, they just didn't have enough capital to cover their positions. Now, that can get extremely dangerous, right? Myself, yourself, and Ian and Liam have had plenty calls about what could cause this and what the end cause could be. So, do you want to speak a little bit about sort of what the repercussions of this sort of short squeeze are?
Yeah, so it's important to, and I think this was sort of what was slightly lost while the frenzy was happening in real time, is that short squeezes shouldn't happen. What was happening was blatant market manipulation. So market manipulation is when you're trying to, there's absolutely no one who's buying GameStop shares was buying GameStop shares because they thought that the company was worth that amount of money.
Yes.
They were only buying GameStop shares to force the people who are holding the shares short into a position where they'd have to buy them, pushing up the price more and more and more.
Which would then earn the people that were buying them long money. That's the point here. Yeah.
Assuming they could get out before everyone else. It became blatant gambling. It became blatant gambling. But the important point is that market manipulation is illegal. What made this particularly interesting was because it wasn't an individual body or a coordinated effort to, so-called coordinated effort. Right. It wasn't done in WhatsApp groups in the shadows or Bloomberg chat, as it's often used in these market manipulation things. It was done for everyone to see on the internet. So it was it was an illegal thing that was happening, but it probably wasn't illegal the way it was being done, if that makes sense.
The result was market manipulation, which is illegal. However, the initiators have said market manipulation, it would be difficult to determine it to be illegal because nobody was forcing anyone or nobody was coordinating per se. Somebody was just saying, look, I'm buying this stock.
Yeah.
Maybe you should buy this stock.
Yes, they have no influence over each other than memes and getting carried away and excitement.
Yes.
Yeah.
Yes.
Yeah. So anyway, there have been lots of market. It's called cornering the market. Successfully owning all of the shares, and then the shorts having to buy the shares from the person who owns them. It's called cornering the market. So there's a guy, I can't remember his name, but a really famous. There's a really good book. It's called something like 12 Business Adventures. I think I lent it to someone, so I don't have it anymore. But it talks about 12 case studies about the business, and it talks about tax law. Sounds fascinating, a great one to start. Law, copyright law. It talks about the failed launch of the Ford Edsel. It talks about lots of things, but one of the things it covers is the attempt to corner the market for Piggly Wiggly Stores shares.
Amazing.
And there's this really eccentric guy who owned the company, and he tried to corner the market in the shares of his shop. And he succeeded, mostly succeeded. And then, as is the case with almost every short, some regulation came in and the market got involved to mess it all up. And then there's some brothers, I can't remember their names. Some brothers successfully cornered the silver market, and I think it was in the 70s.
Yeah.
But again, the market got involved to stop the corner actually happening, and the price of silver skyrocketing.
So when you say the market got involved, what do you mean?
Yeah, well, that's a really poor description of what actually happened. It's really, really dangerous if a price goes wildly out of control.
Yes.
And the reason it's really dangerous is because say I'm short gold, right?
Yeah.
And you're long gold,
Yeah.
right? If you keep pushing the price of gold up, right? I start selling everything around me. I sell all of the books,
Mhm.
I sell my computer,
Yeah.
I sell my tables to keep topping up my margin, right? I sell my house, I
Yeah.
sell everything until I've got nothing left, right? And the price of gold is at some $500, say, right?
Yeah.
If the price of gold, but at the moment I've maintained margin, right? As
Yep.
far as my broker knows, I've maintained margin. If the price of gold goes up to 1,000 like that, right? Which is what was happening with GameStop.
Yep.
The price of the company would double, could easily have doubled in 5 minutes.
Mhm.
I immediately go insolvent, right? Because I've no more stuff to sell. But my broker doesn't know that I'm on the verge of insolvency,
Mhm.
right? So they'll do lots of things, like they'll increase the amount of margin I have to post relative to the stock, relative to the value of the shares for more risky stocks versus less risky stocks and things. But essentially, if the stock price is really volatile, I can go extremely insolvent extremely quickly.
Yes.
And then someone has to pay you, right?
Yeah.
Someone has to pay the person who took the other side of the trade,
Mhm.
right? If I can't buy back the shares, someone has to cover the difference. And that's what the clearinghouses are for. But
Yes.
when you have thousands and thousands of options outstanding, and I think it got to the point where each option was worth like $10,000.
Yeah.
Because they bought the price increase so much that the options became extremely valuable, and so many people are piling into the trade. So much capital is resting on the value of each tick of GameStop.
Yeah.
That at a certain point, if the price goes up to $5,000, which it easily could have done,
Yes.
if they hadn't stopped trading, people go completely insolvent, and then the people that owned the shares long don't even get paid.
Yes.
So it doesn't matter if you were right. There literally isn't money in the system to pay you. So
Yeah,
what basically happens is the clearinghouses start refusing to clear trades because the brokers aren't putting up enough capital against those trades, and it sort of the whole market can grind to a halt. So that's wildly oversimplified, and to be honest, I don't understand the exact intricacies. But essentially, people start asking you to put up huge amounts of collateral, and the brokers don't have that amount of collateral. No one has that amount of collateral. So the only thing that they can do is stop the mania, basically, which is what they did.
Right. And that's what happened with Robinhood and free trade to some point and whatever else.
Basically everyone. Yeah. Basically everyone.
What that means, again, in layman's terms, is the brokers stopped selling the stocks and stopped the allowance. Well, so stop selling stocks, stopped allowing people to buy the stocks.
Right? Or depending on whether you were long or short. So if you were short, they wouldn't let you sell any more. They wouldn't let you get shorter. And if you were long, they wouldn't let you get longer.
Yes. However, you could close your position if you wanted to, meaning you could put the stocks back into the market. It was a wild couple of days.
So their hope was basically that people who owned the stocks long would sell them to the people who were holding them short.
Yes.
And then both the positions would simultaneously go back to zero. So essentially the whole world of GameStop and the meme stocks in general would just de-risk, because the people that were overly exposed on the short side would trade with the people that are overly exposed on the long side. Everything would slowly go back to zero. Like everything would slowly net out. And that did happen.
Yeah.
Well, that did happen.
Yeah. Though there wasn't the gapping that you predicted, right?
No, partly because of this. So because they kind of, if you think of it as a balloon that's inflating, what basically happened is before the balloon got so big it exploded of its own merit. Yeah. They kind of popped it in a reasonably controlled manner, and then it just sort of deflated, and then it kind of people were trying to blow air into it still, but they couldn't keep the balloon inflating, to infinity.
I think, and from the results of this, I think lots of things have happened because of this, right? And I'll lay a couple of bullet points out, and then let's go into each of those. The first is that I think retail investors realized that the power that they could have, right, dependent on the market rules. The second is, I think this introduced retail investors that would never have invested before into what investing is.
Well, what investing is, what wildly speculating is, gambling is two different things. But yes, it definitely, lots of people made trading accounts that they wouldn't have done otherwise. I think.
Yes. And the other, I think, is there was sort of it showed the shady sides of both the hedge funds, right? Because we saw some dodgy shit happen in the aftermarket stuff. And then we also saw really the 1% of Wall Street bets, the people that really understood the financial markets, they also understood that they were going to make a lot of money. And predominantly the most of the largest percentage of the people that were in that trade on the long side were probably not going to make anything. If anything, they were going to lose a lot of money.
So I'm not sure necessarily that the hedge funds were doing anything particularly
nefarious.
I think they were just stupid. Some of them were just, and that's not the right word to use, because they were correct in their assessment that GameStop was probably going to decrease in price, but they didn't realize that the shares outstanding was going to cause them a problem. And no one anticipated the short squeeze happening. So they caught themselves. They were they were exposed basically, and in a way they didn't anticipate.
By the dodgy shit, I meant whilst the short squeeze was happening, there were some things that happened outside of the market hours where, or at least what we determined was happening in the conversations we were having, is that the hedges were attempting to sell their shorts to each other, right, outside of market hours.
That may have been happening. I'm not sure.
Yeah, I mean, we can't confirm or deny, but what it seemed like from I was following Sahil Bloom on Twitter, right, who's basically the oracle of everything interesting, and there were some subtweets coming from him that were saying something similar to that.
Yeah. But trading at artificially low prices to make it look like everything was collapsing to try.
Yes, exactly.
Yeah, I don't know if that's true, but it's very possible.
Yeah, of course. And the thing that upset me, I guess, the most about this whole thing is it showed because a hierarchy built immediately in that WallStreetBets Reddit, where there was a couple of people, deep fucking value, obviously, and then a couple of others that were sort of promoting these things. And the thing that sort of was so stark for me is there was a moment in the monitoring of that WallStreetBets conversation where people were a little bit nervous, right? And things had started to get a little bit shaky. And then deep fucking value just posted immediately saying, I'm still in, and posted his collateral still in there. And everyone was like, fuck it. And then the stock just exploded, right?
I think, to be honest, he's reasonably blameless in this entire situation.
Oh, for sure.
I don't really think he just posted his position every day. I don't think he did anything particularly wrong.
No, however,
I think the people who are most at fault, not most at fault, that's not the right way of putting it. I think Elon Musk and Chamath acted just disgracefully, basically, because they will have caused a lot of innocent people who had no idea what they were doing to lose their money.
Yeah, exactly.
And I think that if you have a large follow account, you have and especially, I think there are lots of people who have large follow accounts who didn't really know what they were talking about. And that's just people being, stupid. And yes, they probably caused their followers to lose some money, but I don't think they really knew any better. I don't think that's true of Chamath and Elon Musk, and I'm sure there were others. They knew exactly what was going on.
Yeah.
And they knowingly enticed people into buying into this crazy situation.
Yeah.
And I think Chamath probably got a call from compliance telling him to get the hell out of the trade the day after or 2 days afterwards and donate all the money to charity to try and save some face. But
probably,
I don't speculating. But I think they were the two people that came out of it from my perspective with who'd acted very badly.
And the reason why I argue that is because the people with the most knowledge in that WallStreetBets subreddit that were involved in the trade. They knew that as that thing started to grow, and that Reddit substream had something like 300,000 signups in like an hour or a couple of days at least. It was absolutely insane.
It doubled. It went 4 million people or something.
Yeah, which is just ludicrous. Now, of course, some of those are bots and whatever. But what I think is they must have known that as that stock exponentially grew, that there was no way that everyone was going to, on the long side, was going to be able to close out their position and make money.
Yes, but yes, that's true. I mean, that's always true. If you're buying something that has no, so I think there's a famous story about sardines, I think, right, where the price of sardines starts spiraling out of control, and you're trading sardines with each other, right? Yeah. And there's something special about a certain type of sardine, and those are more valuable than others, and you keep trading them, and everyone gets more and more excited, and then suddenly someone realizes that they're just sardines and they're food, and you eat them, right? Yeah. So, and then suddenly everyone starts viewing them as a sardine again instead of this magical entity that has some value, and then sort of reality ensues. I just think people, I find it hard to criticize people on Reddit, to be honest. It's a greater fool theory, right? You're trying to sell to someone who's more stupid than you at a higher price.
Yeah, I just feel like you have an obligation in the same way that Elon Musk and Chamath have an obligation because of their large following. Essentially, some of the guys at the top of that subreddit stream, in terms of their intelligence, right, what they knew was going to happen, you just have as much obligation that, okay, you're pushing the price up dramatically, like nothing we've ever seen in the last 10, 15 years, 25 years probably, that you knew that you were going to close your long position and make loads of money, right? And you also knew that by doing that, a lot of people were going to lose their money.
I think part of the thing that made it complicated was that for quite a long time, it was still a good trade. Like if you were buying at 60 the first time, it was still a genuinely good trade to buy the stock, because there were probably some people who still hadn't closed out short positions, and a lot of hype was coming. So it was a reasonably sensible thing. I'm not saying sensible is a poor word to choose.
Yeah, I was going to say that's a crazy word.
It was a reasonable bet to make with a very small amount of money.
Yeah.
And that's the problem, is that at what point does it become a stupid bet? There's some, who defines that, right? Yeah. If you're buying it at 30, that was an extremely intelligent trade. If you're buying it at 60, that was still pretty intelligent. If you're buying at 150, at what point do you become someone who's just wildly speculating? And I think that's kind of hard to define.
I do think it's hard to define. I think you're right. But in the same vein, because this is so unprecedented in a lot of ways, I understand why it's difficult to sort of stop the flow. But I don't know. I feel like there has to be something ethical involved in this, right?
And well, I think, yeah. I mean, my opinion on this. I wrote.
Yes, of course.
If I had a 3-hour WhatsApp conversation or something, I think that the biggest change from this, that I hope comes from it, is that brokers. I think one of the biggest causes of the problem here was that brokers didn't price borrow costs high enough when the shares outstanding, the short interest relative to the shares outstanding started to get very high. People, essentially, the borrow cost is the amount you have to pay to borrow the shares, right? Yeah. So say you think GameStop is going to, its revenues or whatever arbitrary number that's used to value GameStop is going to decrease at 10% a year, right? If you can borrow the shares for 5% a year in cost, you can still make some money, right? Mm-hmm. The problem is that it's not just the risk of the share price going up because of the business doing better. There's also the risk of the share price going up because of a short squeeze. Mm-hmm. And that, I don't think, was priced in enough. So you could, when the short interest was, say, 70%, you could still borrow the shares at at a cost where it was reasonable to assume that the business's decline would give you money, right? Whereas what probably should have happened, and I suspect and hope what will happen in future, is that people who, I don't know who defines borrow cost. I'm not sure who determines that. I'm sure it's partly brokers and partly the market, whatever determines it. You'd hope that in future people would price in the possibility of short squeezes into borrow costs more effectively. So essentially, as the short interest starts getting really high, it becomes so expensive to borrow the shares that no one in their right mind would think it was a profitable trade. And that should deflate these bubbles a lot more, before they even happen. Yeah. Obviously, you can't stop people lighting their money on fire for entertainment purposes, which is what happened here.
Yes.
If it's very difficult to stop market manipulation if the people who are involved in the market aren't trying to make money.
Yes.
Which is what happened here. People were buying the stocks just to watch hedge funds lose money, and they got lied to, because I think by that point there were just as many hedge funds long as there were shorts, probably. But essentially, if people are willing to light their own money on fire, it's very difficult to deflate stock bubbles, because you assume rational actors, which isn't the case. But that's my biggest hope, is that I think there's a sort of paradigm shift in understanding of risk around shorting. And I hope that in future borrow costs, and I might be wrong, my understanding might not be great enough here, but I think that significantly increasing the borrow costs as short interest starts climbing would help deflate these things in future.
Yeah, I mean, obviously I don't know too much. I don't know enough to form really an opinion on that, but I think I wanted to get your opinion on how this shapes the future of investing.
I think that people will be more scared about shorting. Became a lot more difficult. So one of the things that made this especially bad is that you have to disclose hedge funds have to disclose their positions. So basically, Melvin Capital, everyone knew Melvin Capital was short GameStop, right? Yeah. And they knew that Melvin Capital was short GameStop and was burning money on that one position. Yeah. So what people started to do was go to, and I can't remember what the form's called. It's like a 13F. There's a type of form I think that's a type. I think that's one type of form. But there are loads of websites you can go to that list the positions that big hedge funds own. And basically people started a sort of assassinating Melvin Capital's other positions. Yeah. Right. They knew that they were bleeding, so they started going after their other positions, because they knew that they were going to have to close them out, because the amount of collateral that Melvin Capital had relative to the exposure was getting smaller and smaller and smaller. Yeah. So they started blowing up their other positions, right? And I don't know whether it's a good or bad thing that hedge funds have to disclose their positions. I don't really have an opinion on that, to be honest. But it made shorting a lot more risky, because now there's a whole army of people on Reddit who will scour the internet for stocks that have very high short interest, and then can mobilize a huge amount of capital together to buy that stock. And that wasn't, no one had ever done that before.
And that's, so I think, that is what happened, right? In the midst of this GME stuff, somebody posted saying, shorting is dead, right? And obviously that's an exaggeration, but what they meant by that is they were then hoping that they were going to roll that capital that they'd made from GME into the next largely inflated short position. And I think probably one thing just to note on, because I remember wanting to know this previously, a lot of the capital that was brought about by these retail investors came from the crypto booms, right?
I don't know, but I would imagine that's true. Yes. The same kind of person that is likely to gamble on this is likely to have gambled on crypto. I completely believe that. And marijuana and everything else, all of the other, popular areas in recent times. Yeah, exactly.
Yeah, I agree. And sorry, you were about to continue on about how this affects investing going forward.
Yeah, I mean, I think that's the big one. It's more dangerous to short. But one thing I think is slightly been lost in this whole story is that I think people think short sellers are sort of evil people. And there, you can do bad things with short selling. So you can, I think is it called a bear run? So basically, when you short something, at a certain point in the process, you borrow a stock and then sell it. Selling something increases supply, right?
Yeah.
You're increasing the supply of the stock into the market. Increased supply reduces price.
Yeah.
Right. So you can say short something, announce some bad news about the company, whether it's true or not, and then just starts shorting the shares in the market like crazy, which starts pumping supply into the market, craters the price, which causes the people who own the shares to panic and think that what they're reading must be true. So they then start selling, and it can destroy companies, right? That can happen, but that's not that common, right? What also happens is shorting is an incentive for being a detective in the market, right? So there's a company called Wirecard. I think it was a German company, like last year, that got found out as a fraud. And Valiant, is that what they're called? The drug company that got found out to be a fraud. Enron is another one, got found out to be a fraud. And I don't know about Enron, but a lot of the research done that brought these companies down was done by short sellers. And the reason that they do the research is because the way they make money, the incentive for finding the frauds is the money they make when the share prices collapse, correctly collapse, right?
Yes.
Shorting, even when done for sort of speculative purposes, has a value, right? It incentivizes people to find companies that are fraudulent and weed them out, announce that they're fraudulent, and then get them out of the market, so to speak. Right. And then the CEOs get arrested. Whether the CEOs go to prison or not, or get massive paydays is an entirely different argument. But essentially, it incentivizes people to try and find bad actors in markets. And that's even within sort of speculative short selling. It does have good benefits. But then there's another reason entirely people would sell things short that is that doesn't express any opinion on the market whatsoever, and that's hedging. So,
can I explain what hedging is?
Yeah. So, shall I use the sort of Kellogg's farmer example?
Let's do it.
Right. Okay. So, do you want to be a farmer or do you want to be Kellogg's today? Which do you want to go for?
I'll be a farmer today.
Okay. Right. So you're a farmer.
Yeah.
And I don't know if Kellogg's make wheat-based cereal. Maybe we should go for like corn or something.
Sure.
We'll do corn. Okay. So you're a farmer. And you've just planted a whole bunch of corn, right?
I have, actually,
in a field.
Today. Yeah.
You happen to own a really, really large field, and you've just filled it with corn.
It's 15 hectares, yeah.
Exactly. But your corn isn't going to grow until next, I don't know when harvest season is. Autumn?
April. Yeah. I'm going to go with April because.
Right. Well, anyway, we'll say April, right? So, and then I mean that's actually quite soon. Let's say September, just hypothetically. So
April 2022. Yeah.
Okay, yeah, that's a good idea. It's going to take 1 year. So you're planting it now. It's going to take a year to grow, and you'll be able to sell it in April 2022, right? You're a farmer though, so your ongoing business is entirely defined. You're essentially putting the company on the line every year, right? If you're not able to sell your harvest, I don't know if it gets burned or some birds eat all of it or something, I don't know. You're bankrupt.
I'm fucked.
Right? You're screwed. So you have this massive exposure, right? And you've just planted a whole bunch of corn. All your fields are now completely full. There's nothing else you can do with the land. It's now corn, right? But it's not corn now, it's corn in a year once it's grown, right? If the price of corn in that year collapses completely, when you sell your corn in a year's time, it will be worth nothing, right? And you're really worried about this. So what you can do as a farmer is you can sell corn futures, which basically guarantees the price of corn that you'll be able to sell at in a year's time, right? And then you guarantee, so you've basically locked in the price of corn in the future by, so to speak, shorting the corn market. So if the price of corn collapses, you make money on the futures, you lose money on your corn, right?
Yeah.
That's a reason, that an entirely legitimate reason that people would want to short the value of a thing, right?
And just to put that in even more layman's terms, right? If I'm the farmer and I have some excess capital and I believe maybe it's going to be a really hard winter, right? Or maybe there's been an influx of birds, right?
Yeah.
coronavirus birds have come into my area, and I have a real fear that they're going to eat all of my corn.
Yeah.
I can, as you say, hedge my bets, right?
Well, you don't necessarily, just to be clear, you don't necessarily need capital. As a farmer, you can physically deliver on the futures contract.
Yes.
You can literally deliver your corn into the contract, right?
Right. Interesting.
Yeah. Which is why I don't know if you remember, oil prices went negative, right?
Yes.
That was because
there was no oil.
No, there was so much oil. So demand for oil collapsed due to the pandemic. I guess people were driving less.
Yeah.
People needed less heating in offices, and all the storage around the world was full of oil, but they were still producing oil. And people didn't want to take physical delivery of oil, right? Because they were just people who work in offices or actually from home. So they couldn't take physical delivery of the actual oil. So they had to sell the contracts down all the way until they were literally selling them for less than nothing. And the difference between zero and the amount they were selling them for is some approximation of the amount it would have cost them to take physical delivery of oil. Does that make sense? So essentially, they were so worried about someone dumping a bunch of oil barrels that they were responsible for getting rid of, that they were willing to pay less, that they were willing to sell the contracts for less than nothing. So essentially to pay, not to be given oil.
Yeah.
Right. Okay. So yeah. Anyway, back to the point I was making before.
Yeah, sure.
Hopefully that's clear. So but the problem is you only have one side of a trade there, right? So farmers would want to short the price of corn because they're worried about the price decreasing. So they want to hedge themselves against the price decreasing. But someone has to take the other side of that trade, right? Someone has to be willing to bet that corn prices will go up for the farmer to have someone to trade with, right? So the farmer might have a broker or someone, and then the broker's job is to find someone to take the other side of the trade. And I think you were the farmer, I'll be Kellogg's, right?
You are Kellogg's, yeah.
So as Kellogg's, what do I do, right? I take corn and I make it into cornflakes.
Yes.
Do Kellogg's make cornflakes? I think Kellogg's make cornflakes.
They do, yeah.
There we go, right? So what's my concern, right? If I'm Kellogg's, my concern is not that the price of corn will go down, it's that the price of corn will go up.
Yeah.
Right, because people don't have to eat corn-based cereal.
Correct.
If the price of corn goes up and I increase the price of my cereal as a result, people will just eat shredded wheat instead, right?
Correct.
People can make other breakfast decisions.
Shredded wheat.
Exactly, right? So I might not be able to pass the cost of the corn onto the consumer.
Yes.
So I'm worried about the price of corn going up. So I want to buy corn futures, which essentially locks in the price I can buy corn at in a year's time.
Yes.
Right? And there we have a market.
Yes.
So the Kellogg's person can trade with the farmer. And what will probably happen, obviously, is that there'll be thousands of farmers and one Kellogg's.
Yes.
And the broker will net them together, or through some market. And then you have a market, right? You have, for completely totally mundane reasons,
yes.
You have non-speculative reasons. You have two people taking both sides of a futures trade, right? And one of them is shorting, right? And now that's with something like corn. But now let's use a stock as an example. And I'm going to get a little bit. I'm going to try and be a little bit technical.
Go on.
There are these things called convertible bonds.
Yeah.
Right. And Tesla issued a lot of convertible bonds.
Mm-hmm.
And a convertible bond is, I should say, a bond is debt, like a mortgage, right? Generally, you issue a bond to raise capital, to say invest in a project, build a factory or something, I don't know. And then you pay, say, if the bond you sold was £100 and it's a 1%, it's priced to yield 1%, you'd pay £1 every, say, year for 10 years, and then on the 10th year you give them the £100 back and the final £1, right? That would be something like the cash flow of a bond. Anyway, a convertible bond is a bond with an option attached, and an option is basically the right to convert your bond into a stock position, right? And if the stock price goes high enough, that becomes a smart thing to do. Does that make sense? So while the stock price is low, you have a bond, but if the stock price goes high enough, you can convert the bond into equity and own shares in the company. And the reason that companies do this is because if their stock is really, really volatile, that option can be really valuable, right? So the company is essentially able to borrow money at a lower cost by issuing convertible bonds instead of normal bonds. Does that make sense?
Yes.
So Tesla, really, really volatile stock. By issuing convertible bonds, they're essentially monetizing their own stock's volatility.
Yes.
Okay. And now this is where that volatility is just the share price going up and down a lot, or just up a lot or down a lot, in fact. The share price moving a lot. The reason I bring this up is that if you own convertible bonds, you are exposed to the share price, right? Because if the share price comes down, the conversion option becomes less valuable.
Yes.
The value of your bond decreases. So people who own convertible bonds will sometimes sell the stock short to hedge themselves against the risk of it going down in price, which is what happened with Tesla famously for years.
Yes.
Right. And GameStop, I don't know if GameStop issued any convertible bonds. They probably didn't. But my point is essentially that people will short for completely mundane reasons that have nothing to do with them actually thinking the company will go down in value. They just have to hedge themselves against some other risk.
Yes, and I enjoyed that, because that's the second time I've heard you. Because legitimately, I remember when we had a conversation previously about the shorting of Melbourne Capital and whatever else, that it was definitely painted that shorting was, you know, you're the evil man sat behind a desk that's trying to burn a company at the stake if you're shorting them. When actually, as you rightfully said in our conversations, there's a plethora of reasons why shorting is a necessary action in the market.
Yes.
And, you know, because if you can't long if you can't short. Do you know what I mean? Like it doesn't really mean anything.
Well, you kind of can long if you can't short. So let's say we could go for an IPO. So an IPO is an initial public offering, which is when a company goes public, i.e. issues shares to the public, right? The people who are issuing the shares aren't necessarily betting against the value of the company. They might just need to raise money, right? So say you're
like Tesla.
Yeah, so Tesla is a perfect example, right? Tesla wants to build a big factory in China or in Germany or wherever.
Yeah.
They need money to do that.
Yeah.
Tesla doesn't want to take on more debt because they don't. You know my opinions on Tesla.
I do know your opinions on Tesla.
Tesla's cash flows are dire.
Yeah.
Right. Their cash flows are dire, so taking on debt is really risky because they have to actually pay it with cash.
And if I can just stop you, just
go ahead.
I know, I'm sorry, but I just want to just go through slightly why Tesla's cash flow is dire. So I'll explain what I believe what it is, and you can correct me if you think I'm wrong. So Tesla at the moment, they're famous for making cars, right? Electrical cars that are quote unquote self-driving, even though they're not.
Or might be in future, yeah.
Yeah, but they're not right now.
Definitely. Yeah, definitely not.
I mean, nobody is right now, right? Frankly, like nobody is. So I'm not shitting on Tesla. I'm just saying.
No, that's totally correct. Yeah.
Selling the idea of an automated car just doesn't exist yet. Now, the problem with selling cars is that it's a shit business. You know, there's not a ton of profit in making cars, especially cars as expensive as Tesla to make, let alone sell. So if you're go on, you feel like you're going to jump in.
So. Selling cars is a bad business because it costs a lot of money to make a car.
Exactly.
And generally it's pretty low margin.
Yes.
There will be exceptions, like Ferrari, for example, is a very good business, but it's a good business because it's not a car business, it's a luxury business.
Yes.
If that makes sense.
Yes, absolutely.
Tesla is a little bit of a luxury business. Its cars are very expensive and desirable.
Yeah. But so this is what I was going to get to exactly is if you're a Ford, right? Ford is not a luxury business because their cars are affordable. In the same vein, not many people are going to buy more than one car at a time, because generally your use of a car is that it's got 4 seats. You can fit 4 people in. You're not going to buy 4 cars for 4 people generally. Yes. Right? Because and generally what's going to happen is if you are going to buy 4 cars for 4 people, it's not going to be Ford that you're going to buy. You're going to buy Ferrari or Tesla or Porsche or whatever, right?
Yes.
So the difficulty in making a lot of capital and a lot of margin based on being a Tesla is that you're either a luxury car, which they're not quite, because Elon has talked profusely about trying to make cars affordable for people. In the same vein, you need to either have something that other companies don't have, i.e., a technology that makes an automated car, which Tesla still don't have, right? What Tesla do have, however, is batteries at the moment, right? Now, the reason why Tesla are doing as well as they are is for two reasons. One is because of going public and raising a vast amount of capital through essentially a cult following buying the shares and driving the share price up, but also because other companies have a mandate for having electrical vehicles. And the way that Tesla are currently making their money is, let's say I am a Ford, right? Multi-billion-dollar company, absolute household name, giant company. If I haven't made an electrical vehicle, I either need to spend money buying, making an electrical vehicle and doing the technology and all the manufacturing that comes in terms of that, or I just buy it from Tesla. And what's been happening most recently, or Tesla, or somebody like Tesla.
Yes, yeah, exactly. So there are some regulations in place that say a certain percentage of your fleet of cars
Have to be
electric. And what Tesla can essentially do is sell the portions of their fleet that are electric, because all of their fleet is electric, to other car manufacturers, and it's pure profit.
Right.
It's 100% margin, pure profit.
The reason why they would do that, or the reason why Ford, for instance, would do that is because if they don't, the fines that they would receive would be way more than what paying Tesla a couple of $100 million would be.
Yes.
Right.
Yes.
So Tesla are there like, sound. This is perfect for us. However, that's vastly short-sighted, because if you think that Ford, for instance, are just going to happily pay another company hundreds of millions of dollars a year, fucking ludicrous. In the back end, Ford have almost certainly, as we've seen, because they're starting to roll them out, but they will be taking Tesla, they'll be reverse engineering a Tesla car, figuring out what the fuck it does, how it does it, and how Ford can do the same thing to save themselves hundreds of millions of dollars. Now, that spells something really bad for Tesla, right? Because if the lion's share of where their revenue is coming from is by selling to other companies, but other companies are going to eventually stop that purchasing, or the capital goes through the floor, right?
So I would say lion's share of their profits, not the lion's share of their revenue.
Yeah, sure. Sorry.
But yes,
sure.
Essentially, the only reason Tesla has lost money every year it's existed.
Yeah.
And the only reason it's been even mildly profitable in recent years, in occasional quarters, is because of its ability to sell its fleet to other manufacturers. Yeah, I mean, Tesla's problem is that they can't make cars for less money than they're selling them for.
Yes.
So they lose money on every car they sell. And that's probably true. I don't know this is the case, but it's probably true of every single electric car that's sold anywhere in the world.
At the moment.
Yeah. So a lot of other car makers are selling electric cars probably at a small loss, partly just to, progress their own understanding of how to make electric vehicles, because it's expensive to do research. So, they sell cars along the way, partly because it reduces the fines they have to pay, and I'm sure there are lots of other reasons. But essentially, electric cars at the moment, and I think this is probably true of most companies, aren't a particularly good way of making money.
Yes.
But people are buying the future when they buy electric car manufacturers, right? And that's that all cars will eventually be electric. So the people that do it the best now are probably going to be the people that do it the best in the future.
Yeah,
I am wildly more bearish or less optimistic than most people seem to be on the profitability of Tesla should it be the dominant electric car maker in the future, partly because the percentage of cars that are sold over a value of $40,000, I would imagine, is extremely small. I reckon the vast majority of cars that are sold worldwide are much cheaper than $40,000.
Almost certainly. Like, I mean, how many people just do you know in your personal circle that have 40 grand to low on a car? Not many is the answer.
Not many.
Not many. Now, that doesn't mean to say I wouldn't like a Tesla. They look like loads of fun, but I wouldn't purchase a Tesla because I'm so invested in the company and the stock. It's because I want a fun car, right? But that's not to say that you can't find a fun car under 40 grand, because you absolutely can.
Yeah, and I think I'm all for. By the way, while I'm not a huge fan of Elon Musk, because of his.
Okay, let's get into that. Why do you hate Elon Musk?
I don't hate Elon Musk.
I'm joking.
I think he has committed fraud multiple times.
Interesting.
I think when he claimed that he was taking Tesla private at whatever $420 a share, that was fraud.
Why do you think that was fraud?
Well, I mean, he is the CEO of a public company. He stated that he had funding secured, i.e., someone had allocated capital to buy Tesla at $420 a share, and he announced it to the market. And I think that's. I mean, I think it is. I think it's fraud.
Right.
And fraud in stocks gets very, very complicated because almost anything is securities fraud. I.e., if you make a positive prediction about the value of your company in future in an earnings report, and then it turns out that the CEO has committed multiple acts of sexual harassment and is about to be fired as a result, was that CEO committing earnings fraud when he or she made the positive statements, right? Because they knew that they'd done the bad things, and that it would tank the share price if it came out. So, it gets pretty complicated. There's a guy called Matt Levine, who's an absolutely amazing, I don't know if he's really a journalist, blogger, I guess you'd call him.
Social commentator.
Anyway, social commentator. You should read Matt Levine. He works for Bloomberg. He's amazing. But he talks about this a lot, how you can call almost anything securities fraud. But I think Elon Musk is a particularly obvious case of really, really questionable accounting practices. And he's done it repeatedly, and I don't think it's particularly ethical. And I think that I am of the opinion that Tesla is, worth many, many multiples of its true value, and that is due to him misleading shareholders, and therefore he's going to cause a lot of innocent people to lose a lot of money. But I might be wrong. Anyway, but the reason the reason I'm conflicted is that I am all for electric cars being the vehicle of the future, and I think he's done a great deal more than anyone else on Earth.
Absolutely,
in making that true. I think that space exploration is really, really cool, and I think it's one thing that unites humankind more than I'm just as excited to watch SpaceX rocket land as I'm sure someone anywhere in the world is. Right, it's a really exciting thing for humanity to be pushing towards space. So I don't hate Elon Musk. I think he's amazing, and I wish there were a lot more people like him. But
I think the delineation that we probably need to make is that Elon Musk is, and I use this word and I think it's probably justified, is a genius, right? In his field. His field is not being a CEO though.
Well,
it's not.
Well,
he's an engineer.
Tesla's most valuable product is its own stock.
Yeah, sure. But
Tesla would have gone bankrupt a long time ago if Elon Musk wasn't its CEO. So by definition,
it's not because he's acting as a CEO though, because the CEO is attempting to steer a company in the right financial. He doesn't give a fuck about that. All he cares about is, can I make more rockets and more cars? If the answer is yes, cool. If the answer is no, I'm going to go to Twitter and tweet buy Tesla, and fucking the world buys Tesla. That's not being a CEO. That's being a celebrity.
Yes,
that's being an influential person. It's not being a CEO.
I agree with you. I agree with you. I think that Tesla needs a Tim Cook. Tim Cook is the CEO of Apple.
Yes.
Who it's been argued, and I don't even know if this is true necessarily, but it's been argued that he isn't particularly good at innovation, i.e. Apple hasn't innovated particularly well. But what Apple has done is it's an incredibly well-run business.
Yes.
And as a result, someone like Tim Cook could go to Tesla and run the business very, very well, and let Elon Musk do all the engineering and innovation and so on.
And this is exactly my point, right? Like let's take this again into a slightly different sphere, and I'll give you this example, and you'll see if you agree.
Go for it.
At no point in Cristiano Ronaldo's career would I have expected him to walk out as Manchester United manager. It would have been fucking farcical, right? Even less would I have expected him to, at the time, to step into David Gill's position and be like, all right, lads, I'm going to take over from here. No. your position is on the field being amazing, right? It's not up here making all the really important decisions that equate for you to be able to do the thing that you're really good at. Elon Musk is there because nobody else would believe in his ideas. We just decided, fuck it, I'll just do it myself. But to me, that's a deficiency to his genius.
Yeah. Yes. Okay. My opinion is I don't think Tesla could have an out of Tim Cook as a CEO, because I suspect, this is my theory, right? And I might be completely wrong. I suspect an honest earnings statement, like an honest balance sheet, up to the standards of an Apple. And as far as I know, Apple is a perfectly is doing nothing wrong. I might be incorrect. I don't know. Let's say Berkshire Hathaway. I think it's pretty. At this point, people are pretty trusting of Warren Buffett, but maybe they're wrong. Who knows? If a truly honest depiction of Tesla's balance sheet would destroy the company, I suspect, and thus a Tim Cook would never go near Tesla. And by the way, that's less true now than it was a year ago. Tesla's sold a bunch of stock, billions of dollars worth of stock, and has shored up its balance sheet with the money raised from selling equity.
Sure.
So it's probably less bad, but I think that there are many points in its history where an honest depiction of its balance sheet would have destroyed the company.
And do you think one of the other reasons, one of the more personal reasons, I suppose, is that it would just be almost impossible for a Tim Cook, who I'm sure has a vast ego, to work alongside productively another vast ego like Elon Musk?
Yes, that's probably true. And I don't know if Tim Cook has a vast ego, but I think that Elon Musk's, this is my opinion of Elon Musk, right? I might be wrong. I don't think he gives a crap about anyone who works in finance. I think
certainly.
And I think he just thinks they're all wasting their life doing nothing useful. And I think he's largely, I don't think he's entirely correct, but let me just put it like this, right? I work in financial software. I think a doctor is far more useful to society than I am. Yes. I think an engineer is far more useful to society than I am. I think an architect is far more useful to society than I am. I think anyone that runs a business that produces something that's useful to people is doing more for society than I am, right?
Yeah.
And I think Elon Musk is of the same opinion. So I think as far as he's concerned, anyone that's involved in finance isn't worth his time worrying about. He, as you said, he just wants to make cars and make rockets. Yeah. And anything he has to do to get that to happen is a justifiable means to an end.
Yes.
Right. And so I don't think he's evil. I just think he just doesn't care.
Yeah.
And I think and by the way, I think that a lot of people who have bought Tesla stock know that.
Yes.
And they're just making and I think a lot of them are almost buying Tesla as it's not quite a charitable donation to the future, but they're almost considering it as a donation to the future.
Yeah.
And they're very welcome to do that as far as I'm concerned.
Yeah, I mean, I think of all the interviews that I've watched of Elon Musk, and I've watched a lot because I think he's brilliant, just to listen to the way his mind works, is that you're right. He's probably learned the intricacies of the stock market because he understands that it's a game, and it's a game that he must play in order for him to play the game that he actually wants to play, which is making rockets and building cars and innovating and doing whatever. So he will, I don't want to use the word manipulate, so I'll use the word play. He will play the game of the market in order to facilitate him being able to do the things that he loves.
Yeah, and I also think he just loves memes, and he literally does it because he finds it funny.
Yes.
I think he just does things because he finds them amusing and doesn't care that he's a CEO, and therefore the things he says are supposed to be taken seriously. Right,
because I think at the very core of it, he's just an engineer, and he still sees himself as just an engineer. You know, like, did you hear about him selling his house?
I had heard about it, yeah.
Yeah, so the reason why he sold his house is because he looked around and he was like,
I don't need all this crap.
I just don't need all this shit.
Yeah, yeah.
Yeah, so he decided to move him and his family to a rented accommodation of like a 2-bed house. And I'm like, that's amazing.
Yeah, however he views himself, I don't know how he views himself.
No.
I have never held a position in Tesla or any stock like Tesla, long or short.
Mm-hmm.
I just don't care. People I know who I know will have probably made thousands and thousands and thousands of pounds investing in companies like Tesla,
Yeah.
and they're richer than me, fine.
So
I don't
the first big win, and probably the only big win I have made from investing was Tesla. So when at the last drop, I put money in Tesla. And then most recently, obviously, as it's climbed all the way back up, I sold again and I made a good amount of money. I think I made like £700 or something.
Yeah.
Which is the biggest win I've ever had in investing. And it was because, like you, I had a feeling that Tesla was a bit of a shit company at its roots. And I don't mean that in the innovation that it produces. I mean the actual business as a business, structurally. And then having a conversation with you, I was like, oh boy, fuck Tesla. I'm getting rid of this immediately.
Well, but my opinion on what companies I like has changed a lot over the last, I don't know how long I've been, 4 or 5 years I've been looking. Like, I started really getting interested in finance in 2014.
Right.
But I didn't really have any idea what I was doing at all. And I mean, it's very arguable. I still don't know what I'm doing.
I was going to say, I am so far away from having an idea what I'm doing.
But like at some point along the way, I made enough mistakes that I kind of thought, okay, I don't want to do this anymore. I don't want to do this anymore. I don't want to do this anymore. But it literally took me years to kind of get to that stage where I kind of have an idea now of what I don't want to do more than what I do want to do. And I just don't like company. Tesla to me is a company where people have bought so much of its future already that even if it becomes the true, it doesn't make you don't make any money from it, right? The only way you make money on Tesla is if other people get so hyped about the possibilities of its future that they buy the stock from you at even more money. Essentially, they buy even more of the possible future. Because when you buy a company like Tesla or any of the kind of ARC type companies, Cathie Wood's, extremely new, fresh technology companies, what you're essentially buying is the possible future. You're buying revenue that is from products that haven't necessarily even been designed yet, right? There's just the possibility that they might be really cool and really innovative and world changing. And sometimes if you guess right, you make an absolute fortune. If you bought Apple in 2006, probably when they made the iPhone, something around that.
When the stock was something ludicrous, like a couple of dollars.
Yeah, you thought this iPhone is better than anything else by miles. And then you also thought that people were going to design apps that would become an ecosystem on the iPhone. And then you also thought that Apple would then also, on top of the iPhone, would be able to sell laptops, iPads, devices that you could connect to each other, and you'd be able to have an entire ecosystem of all your devices. And then on top of that, you saw all of them, if you thought the earbuds that people would be able to sell, right? And then the watches and everything. If you predicted all of that in 2006, you could have paid almost any price for Apple and you'd have been making a brilliant investment, right? You could have bought Apple at a like $600 billion valuation in 2006, and you'd have still made 5 times your money almost.
Yeah.
In 15 years, which would have been a good investment.
I had a friend. This is a crazy investing story. And I mean, I'm sure you've got tons of them, but I had a friend that put 10 grand into Apple in 2004.
Right.
And
does he still own the shares?
No.
Do they still own the shares? When did they sell them?
So he sold them in 2007 because he thought the iPhone was shit.
Oh God.
The first iPhone came out and he was like, oh no, this is crap. This isn't going to do anything. Imagine what that 10 grand would give him now.
It would probably be crazy, but it wouldn't be. I don't know, what was Apple worth in 2004? I have the internet. It wasn't a lot. You're right. Let me check.
Here we go. We got some live Googling. Pull that shit.
We have live Googling.
We do.
I have to go back a long, long way. Oh, it doesn't even show. Apple. Oh, here we go. 2004. Oh, wow. Okay. Yeah. It was like $1, let's say.
Yeah.
And it's now $127. So he'd have made
a lot of money.
1.27 million or something like that. Yeah, that's a lot of money. Yeah, crazy.
And even worse than that, I think. I mean, this is way more volatile. But a person that I know that I used to work with at my current company, his friend introduced him to Bitcoin in the early 2000s, right, when it was just an idea.
Yeah.
And he put $100 in, and he had something like 1,000 Bitcoin. And then again, sold it before the boom. And like,
Yeah.
imagine now 100 Bitcoin, you're a millionaire. Like you're sitting really, really pretty.
Yeah, that's crazy. Yeah. But it's these things happen. You want to hear the worst story I have about missing out on an investment opportunity?
Go on, please tell me it's
This is a
yours.
fun story. It's mine. Yeah.
Excellent.
It's not big. It's when I was a student and I had absolutely no money at all.
Yeah.
But taking you back to my my youth. There's a company
you're not even
called
that fucking old now.
I'm 27. I was probably
So
how old
am
would
I,
I
you
have been?
prick.
20. I was probably 23 at the time, right? There's a company called Lucara Diamond Corporation.
Okay.
Lucara Diamond Corporation, right? And I was after university one day in the evening at like 6 p.m. I was reading a website called Seeking Alpha, which is where a bunch of people post their theories about stocks. Very dangerous website because you have no idea about the quality of the people who are posting research.
Sure.
I wouldn't recommend using it. I used it and lost a lot. Well, not a lot of money, but by my standards at the time, a lot of money. Right. Anyway, I read this article on Lucara Diamond Corporation, and I thought to myself, okay, this actually seems like a reasonable investment based on, I can't remember the exact thesis, but I think it was trading down on the thesis that people would not buy real diamonds anymore. They'd buy fake diamonds. And the market for real diamonds it wouldn't go away, but it would be sort of lessened by the fake diamond market, right? The artificial diamond. And the guy was basically saying, that's complete crap. No one is ever going to give their fiance a diamond ring with an artificial diamond because it's cheap. And it's the one decision you make in your entire life that you're completely not allowed to be cheap on, right?
Yeah, sure.
Right. So anyway, I was like, okay, this makes sense. And I was like, should I buy shares? Should I buy shares? I'm thinking about it. And then 9:16 passed or something, right? And then the US market closed, or the Canadian market. I can't remember where it's listed. Anyway, and I was like, damn it, I'll have to wait till tomorrow. I'll buy shares tomorrow, right? And you can Google this and it's 100% true. You can Google this to prove it, right? 15 minutes later, I see a press release from Lucara Diamond Corporation announcing that they found the biggest diamond that's been found in the last 50 years.
Oh no.
And it's worth something like $30 million, right? And this company was worth nowhere. It was a small company. So this was like their entire more than 1 year's worth of revenue in one diamond. And I'd missed out on it by 20 seconds or something.
Jesus.
And I was just thinking to myself, wow. Wow. The amount I'd have made was like £150 or something, right? It was tiny.
Still.
But for me at the time, I was like, how did I screw that up? How did I mess that up? Yeah. And it was literally 15 minutes after the stock market closed that they released a press release or something.
You'd be furious.
Well, yeah, maybe an hour, I don't know. But I was gutted. So that's the first terrible story. Do you want another one?
Of course.
Okay. I really like airport stocks, right? I think airports, not airlines, but airports are brilliant businesses. And the reason airports are brilliant businesses there's many reasons, but let's just start with, you go to the airport, right?
Yes.
To start with, airports are generally located near big cities.
Yes.
Right? Land around big cities is incredibly expensive. Mm-hmm. And there are all sorts of environmental reasons why it's very difficult to build a new airport around a big city. People who live nearby don't want don't want all the noise, fumes, pollution, everything, many reasons. So essentially, once you've built an airport, it's very difficult to build another airport to compete with it, right? So you have this it's called a moat in investing around your asset, right? You then go to the airport. You'll drive to the airport, right? And you'll park your car in an airport car park.
Well, not if you're in London, but yeah, sure.
Right. But let's say you go to London. You might get on the Stamford Express or the Heathrow Express, whatever, right? And that train line might have been built by the airport and they'll get the money from the ticket revenue, right? So you're already paying the airport money just in the process of getting to the airport, right? And let's say you're a family, you park there, you're going on holiday for 2 weeks. You're going to pay I don't know, I'm just completely guessing off the top of my head, like 250 quid to park at the airport, maybe something like that, right? Okay. You then go into the airport, right? And because it's an international flight, you're in the airport for how long? 2 hours before your flight? Maybe even
Good
3
couple of
hours?
Yeah.
Right. Let's say you've got 3 children, right? One of them forgot their flip-flops. One of them doesn't have any sunglasses. You don't have any sun cream. You didn't bring any toothpaste. The dad needs a razor. Oh, it's duty free. We might want to buy some, I don't know, aftershave, maybe some whiskey or something. Right. You've spent like 400 quid in the airport already, right? In a shop in the airport. Let's say it's not 400 quid. Let's say it's like 50 quid. Maybe you need some clothes. One of you didn't have any shorts and you didn't have time to go and get them beforehand. Whatever, right? Then you need to eat because you're in an airport for 3 hours.
Yeah.
So you need to eat. So you then go and have some food, right? And then you might want to buy some food for the flight as well, because the children are going to need some sweets to chew on so their ears don't pop.
Yeah.
Maybe they want some drinks or something, blah, blah, blah. Okay, so you've probably spent, I don't know, 100 to 200 pounds in the airport, 300 pounds on parking. You spent 500 quid already, right? You haven't even got near a plane yet. Then you have to go through, well, actually at this point you've checked in, you've gone through security, but you have to check in, go through security, all these things, right? You're paying for that. You don't realize you're paying for it, but you are paying for it. And the reason you're paying for it is because the airline has to pay the airport for the services. And then that price gets included in your ticket. So when you buy your ticket, you're paying for baggage handling, security, check-in, luggage. Oh, I've already said luggage, but you get the idea, right? On top of that, the airlines have to pay for refueling, plane movements, landing fees, takeoff fees, whatever, right? All these hidden fees that you're paying for when you buy an airline ticket without even knowing, right? All of this goes to the airport. And when you buy stuff in the airport, you're essentially paying the airport, even though you're actually paying a Wetherspoons, because the airport, the value of captive customers is much higher than it is on a high street, right? So the rent that Wetherspoons pay in an airport is going to be way higher than it would be on some street in anywhere else, right? Because essentially there are a bunch of people locked in a specific place where your restaurant is. So you're much more likely to get people to sit there, right? Anyway, so for that reason, I think airports are really amazing businesses, right? Obviously, they had a pretty nasty year last year.
Sure.
Right, but I've owned airports for quite a while, and I've generally done very well on them until last year. And in fact, even last year, by the end of the year, I was pretty much break even on my airport. But there's one particular airport in China, actually, and it's called, I don't know what it's called now, but it used to be called, the stock used to be called HNA Infrastructure. And it's, I can't remember, it's the island called Hainan, I think. It's Meilin International Airport, something like that, Hainan Meilin International Airport. And it was trading at a price to earnings ratio of 4. Price to earnings ratio is you take the amount that the company earns in a year and divide it by the price.
Yeah.
And you get some number. 4 is very low. Most airports trade at 20 plus, right? And this airport was growing profits at, I don't know, 20% a year or something. I can't remember the exact numbers, but it was growing quite fast. The only problem was, you may actually remember this, HNA is a Chinese company that bought loads of really expensive buildings all over the world. But it was very controversial because it was, there were ideas that a lot of the people involved in the company were senior government officials in China.
Yeah.
Right. And HNA, the company, owned a lot of HNA infrastructure. And there were some dodgy dealings between HNA infrastructure, the airport, and the company buying the airport, buying like runways and stuff. So I was looking at it and I was like, I know this is cheap. This is stupidly cheap, but I just don't want to get involved in this HNA infrastructure, HNA business. I don't trust management to act intelligently, so on and so on. So I didn't buy any shares. Anyway, if you look at the price of the airport now, it's...
Let me Google it while we're on.
Hold on. I think it's 0365 is the ticker, something like that. Is that right? No, not 0365. What's it called? Let's see if I can find it.
It's 0357.
0357. Yeah, look at the price now.
Yeah, 33.
33, right? So it's not crazy, but I put like weeks of my time into researching this company.
Yeah.
I don't even know if the annual statements are in English. I think I had to translate them from Mandarin or something.
Amazing.
Right. So I put weeks into researching this company. I was reading like the exact fine print of the airport, the runway deal with the company, and I was just like, I can't do this. I don't trust management. So I didn't buy the shares, and then they absolutely skyrocketed last year. And I think the reason that they skyrocketed was because the island, Hainan Island, got some special tax status.
Right.
So I think you can go there and gamble or something. I'm not exactly sure. To be honest, it's like luxury shopping or something.
Right. So for the listeners,
yeah,
the price just before it exploded was about 4.7 HKD.
I was looking at it at like $2. It went down to $2, and I was thinking, oh, it's dipped 50%. This might be a good entry point. I think it went down really low. Like on one day, it was down at $2 at one point, I think.
And it's now it's at its peak, which was around sort of 7th of August. It was 56 HKD, 54 HKD. And if we just do a little on-site translation.
You've muted yourself, by the way, Harry. I don't know if that was intentional.
Yes, because I have a really loud keyboard.
Yeah, mechanical keyboard. I have the same problem.
So if we do 54 HKD, that's £5 sterling per Hong Kong dollar. Yes. So if when it was at its lowest, which was
I think that's
37 pence.
Yeah.
So you could have put £100 in at 37 pence, and you'd have made a fucking lot of money.
And I was thinking, and again, I was looking at putting like £5,000 in.
Oh my God.
Because I was like, this is so cheap. Because I had a list of all of the publicly traded airports in the world, right?
Yeah.
I own some shares in a Mexican airport at the moment, and an Indian airport. Yeah, of course I do, exactly. But I had a list of every single publicly traded airport, and it was so cheap relative to all of them. It was nuts cheap, made no sense at all. Yeah. I think Shanghai Airport was trading at 30 price to earnings ratio, right?
Right, Jesus.
To put things in perspective. Yeah, and I was like, if this just does nothing and multiple expansion takes over, I'm going to make
a lot of money.
7 times my money, something like that. Yeah. But I just couldn't do it because I didn't trust the management to be sensible. And I think, by the way, that's really important. So one of the lessons I don't regret not buying the stock.
Yeah.
Well, that's not. I do regret it because I could have made a lot of money, a lot of money. But I don't regret it because there was a legitimate reason I didn't make that decision, and I still believe that there was a legitimate reason I didn't make that decision. And I've invested in some stupid companies. There's a company called China Plastics. It's like CXDC is the ticker. I wonder what it's priced at now. If it's even listed. Yeah, right. Look at CXDC, right? That company is nuts cheap, or was just stupidly cheap. But the management just ran into the ground, basically, right? And I bought it at something like $4 a share and sold it when it was at $3 a share or something. I don't know.
Right.
And then there was a coal company I bought, which was trading at it's again, to use some slight jargon, like a free cash flow yield of like 30 to 40%. Mm-hmm. Which means that if you buy the stock, say you buy the stock for $1, the company has produced 40 cents of cash in 1 year, right? So if they do that for a few years, even if the company goes bankrupt, you've made back your investment in cash, right? And I was reading this and I was thinking, this is insane. I think a company, what was it called? It's called Contura Energy. Energy. I think they've changed their name now, but the ticker was CTRA. And I was looking at the stock and I was like, this is amazing, right? But the problem is, if the company's run by someone, when you invest in a stock, there are only a few ways you can actually make money, right? The company can do really, really, really well operationally and make you zero money, right? Because at some point you have to get the money back.
Yes.
And when you exit a trade, there are only a few ways you can get money back. One of them is dividends, i.e. the company pays you capital in the form of dividends. And the other one is you sell the company for more than it was than you bought it for, right? Yeah. Okay, so let's go through the first option. So dividends, the CEO of Contura Energy would have had to have made the decision to distribute the cash in the form of dividends, which would have been a reasonable thing to do, right? The other thing that they could have done is they could have bought back their own stock, right, at the 40% free cash flow yield, which would have been ridiculous. You'd have been buying the stock at an insanely cheap price, and the free cash flow yield would have the value of the stock would have been exponentially increased as a result of them doing this, right? What they actually did was bought another coal company for way too much money,
right?
And that coal company was involved in tons of litigation, which was unresolved and just destroyed. It was just insane. It was a terrible capital allocation decision.
Yeah.
And then the price of coal tanked. So so I learned a serious lesson that don't buy company. Like it really matters who's running your company.
That is a really interesting point. So
go
on. Sorry, go on, finish your point.
Essentially, I made what I thought at the time was a pretty sensible investment decision and was reasonably low risk. But then the CEO of the company, and by the way, the price of coal tanking would have made my investment bad anyway. But the CEO did something that was so, let me put it like this, right? And this might be wrong, but this is just my theory, right? The way people generally become the CEO of companies is that they start working in the company at some reasonably junior level, and then they gradually get more senior until they run the company. And that's not always true, but it's often true, right? When you work in companies at a junior level, your role is generally operational, right? Yep. It's frequently operational. So let's say you're in the coal business. Your job is to get coal out of the ground, as much coal as possible, and probably for as low a cost as possible, right? And as you get more senior, you're in charge of getting more and more coal out of the ground. And maybe you're not actually directing people drilling the coal. Maybe you're just, receiving reports and telling people where to drill and making decisions about which mines to do. But anyway, your job at whatever level is essentially getting coal out of the ground. Mm-hmm. Then you become CEO, right? And suddenly your job is no longer to get coal out of the ground. Your job should be to make the best return for possible, to make the most money for your shareholders as possible, i.e. the highest return on equity possible, right? So every decision you should make should be, I have some cash, I'm going to make a decision with how I invest this cash. That could be either in dividends, buying back the stock, capital expenditures on coal mining equipment to mine more coal more efficiently, buying more coal mines, buying other companies, right? You have tons of things you can do with that money. But because you've spent your entire career trying to get more coal out of the ground, generally your decisions are going to be based around how can I get more coal out of the ground, not about how can I make my shareholders money. Yep. And I think that there's this really weird disconnect with the mentality it takes to get to CEO is nothing like the mentality it takes to be CEO. The only job of a CEO should be capital allocation. And, sales and being a representative and a voice of the company. But like one of the really, really key things that CEOs should do is allocate capital to where it's most valuable. Mm-hmm. And if CEOs do that badly, then they destroy value for companies. If they do it well, then they make value for companies.
And that still supports my point. Like, so as I say, I got into investing really at the start of lockdown. So the reason why is a couple of my friends, like one of my friends trades gas. That's his job, right? And he said to me, with this lockdown stuff, like markets are going to crash. And I was like, what does that even mean? And he said, like, just download this app and watch the graphs. So that's how it started for me, right? I was like, why is everything red? Like, why is everything red? These things, and I started looking at then, like, I did the normal thing. I looked at stuff that I knew, right? Manchester United, Apple, all this stuff. And I'm like, why are they going down? And then, I started to do more research, blah, 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 blah. Now, the company that I came across that sort of supports your point is a company called My Wall Street. You ever heard of My Wall Street?
I haven't.
Okay, so My Wall Street it's run by a guy, an Irish guy, and essentially he offers investment advice, right? Now, what he does, or his investment principle is he doesn't care about what the company is. He cares about who runs it.
Right.
And his principle for every single investment he makes is, if I trust the person to do a good job, I'll invest my money.
Mhm.
Every month they release for the sort of the basic subscription service. They will release their stock of the month, and they will give you a couple of 1,000-word essay on why Emmett, who's the guy that runs it, has chosen to invest in that stock. For a slightly higher subscription, he will give you a look at his personal investment portfolio, and he will give you like a really short sort of 10-15 minute rundown of why he thinks this person is worth investing in. Now, obviously, he's a multi-millionaire, and his investments are whatever. Like the most recent one is, have you heard of Ultrix? You know what Ultrix is? So Ultrix is a tech company. They're basically a digital representation of big data, right? And he was like, oh, I made a small investment in this. And I checked, it was 24 grand. I'm like, right, okay, cool. A small investment. But to these people, that is a small investment, right? But his entire premonition of what he determines to be a good or a bad stock is, what does that CEO do with companies? And it seems smart to me, right?
I think it's very important that you have an intelligent, well incentivized person running the company. But yes. I think Warren Buffett said something, and I'm butchering the quote, but it's something along the lines of, if you have a great CEO and a terrible business model fighting against each other, the terrible business model will always win. Mm. And I think that while it's true that you never want an idiot to run a company, I think you should invest in companies that could be run by idiots. Like Coca-Cola is an example. Like, you can drastically misexecute being the Coca-Cola CEO relative to being like a bank CEO, for example. And your company will still be fine because the entire company is tied up in a brand. And I guess you can damage the brand and so on, but it's much harder to screw up than it is to screw up a bank.
I agree. And I mean, obviously that's not to say that Emmett just invests in absolute piles of shit that
no,
ran into good people, obviously. But
you have to consider, my point being that I completely agree with that philosophy, that you should always invest money in companies that are run by people you trust.
Yeah.
But I also think that the business model and the valuation are very important as well, because good people can run bad businesses.
Yes, and vice versa.
Exactly.
Yes, exactly. Man, there's so much, like, from a very, 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 a person that's super new to this stuff. It seems like an absolute myriad of information to get through. And it seems like you have been doing it 5 years. There's still a myriad of information to get through.
Yeah, I'm really not an expert at all.
No.
Not really. I sort of slowly realized, as I was saying earlier, that my kind of investment approach has slightly changed over time. I'll tell you how I got interested in finance. It's a completely true story. I tell it in interviews. If I ever have an interview, I always tell the story if someone asks. I did geophysics as an undergrad.
Interesting.
It's a very interesting course, but I just wasn't particularly, I wanted to be a volcanologist.
Okay.
Which in my mind was like Indiana Jones, but for volcanoes.
Sure.
Right. And then I just sort of realized as I went through university that, one, not very many people are volcanologists. It's not, jobs tend to be where money is, and there isn't much money in volcanology.
Right.
And also that I wasn't as bothered by working in an office as I thought I would be when I was 18.
Yeah.
And then I sort of accidentally discovered finance. I think I was watching a TV show. I think it was like Suits or something.
Excellent choice.
And there was an investment banker in Suits. And I was like, oh, I wonder what, like, investment banking, I wonder what that is. So I Googled it. And then I sort of got mildly interested in stocks, very mildly interested in stocks. But I have quite an obsessive mind. When I get interested in something, I kind of, my entire life takes a back seat to whatever I'm doing. And anyway, so I started doing some stuff on stocks, and I'd done geophysics. So I was looking at oil companies because I had some vague notion that I understood how an oil company worked, because I had some experience with the process of finding oil.
Yeah.
Right. Anyway, so I was looking at the company Shell, and Shell trades on 2 exchanges. Mm-hmm. and it's priced in 2 different currencies on both those exchanges. And I was like, hang on a second, I can make money here, right? I was like, I can buy Shell stock on, I think it's listed on like the Amsterdam exchange. That might be completely wrong, might be Frankfurt. Anyway, I think it's listed in London and whatever other exchange. And I thought to myself, I can make money here, right? I can buy it on one exchange, convert currencies and sell it on another exchange for more money, right? I didn't know about shorting. I thought I could literally buy the like French listed or whatever current country listed Shell and sell it on another exchange. I don't think you can do that. I'm pretty certain you can't do that. But I didn't know that at the time. And I was like, I'm going to be a millionaire. I think it was like 2:30 in the morning. My sleeping pattern was completely screwed up.
Yeah.
I was like, I found this, and I think I stayed awake until 6 a.m. trying to work out how I could open a brokerage account, how I could do this trade. And I was completely hooked, right? And then I woke up the next day and I spent the whole day trying to work out how I could do this trade. And in the process of trying to work out how I could do this trade, there was this website called, I think it was Wall Street Oasis or something.
Okay.
Which at the time was free. And you could create like a fake stock account and you could do all these courses on stocks, right? They did all these videos and stuff. And I did all of the courses in 2 days.
Excellent.
Hours and hours and hours of these courses, what a bond is, what a stock is, blah, blah, blah. And obviously, once I sort of started to get to the end of the courses, I realized that what I was talking about was arbitrage and should never happen in financial markets, because if the opportunity ever arose to actually do it, someone would do it, and in doing so would make the opportunity go away, right?
Yeah.
If something's too cheap in one place and too expensive in another place, people will sell it where it's too expensive and buy it where it's too cheap, and thus move everything back to the equilibrium, no profit price, right? But anyway, I'd become interested at this point, and I was genuinely curious about financial markets, and I'd learned a reasonable amount.
Yeah.
So then I started reading, and I read The Intelligent Investor, Security Analysis, One Up on Wall Street, like every book that you're supposed to read on finance. I started reading all of them.
You.
Yeah, like all of this area here is just that security analysis. Which way does my finger go? Security analysis is there, over there.
Yeah.
And then there are a bunch of case study books, like When Genius Failed, Inventing Money on the Long-Term Capital Management, Liar's Poker, tons of books. I just read loads of books. And yeah, I was completely hooked. And then I ended up going to do a master's in investment and finance and working in a financial software company as a result. But yeah, I mean, I can't even remember the original point I was making. Yes, I can. How my investment philosophy has changed over time. Yeah, so I sort of came from the value investing, deep value view, where you could buy a company for like net cash, i.e. you're buying a company's for $100 million, i.e. not I'm buying $100 million worth, but the company's market cap is $100 million and it has $80 million of cash, right? So you're essentially buying the company, all of the rest of the company for $20 million, if that makes sense. But the problem is, and value as an idea has done terribly over the last however many years since I started investing. For many reasons, I'm sure, but it's just done very badly. And the problem with investing in these companies is that at some point, someone has to come along and realize that this company is worth way more. Yes. And take an action to affect that value change, right?
Yes.
So, and there's no reason that should happen. Like, I think there's some hotel chain in the UK, right? That's the entire value of the hotel chain is way less than the value of the hotels that they own. Right. But the problem is the CEO has absolutely no interest in selling the hotels. So that's never going to be, you're never going to actually get that value. It's called a value trap.
Yeah.
Right. And there are lots of these cases. There are tons of instances like this. What are they called? MSG, the company that owns Madison Square Garden. Yeah, the stadium, Madison Square Garden.
Right.
And they own like they own the New York Knicks, I think, or something, and a hockey team. The value of the assets are worth way more than the company, but the person who's running them, for years didn't have any interest in achieving that value. So you don't necessarily get the value coming back. And I made all these mistakes. I bought that China plastic company. I bought the coal company. What else have I bought that was stupid? Many things I bought that were stupid. Oil companies that were stupid. And I now have come to the idea that I have to like the business model if I'm buying a company.
Yeah.
It doesn't matter. Price is really important, and I won't pay a stupid amount, but I have to really like the business model to buy the company. And I think that saves you from you can be wrong about how good the business is, right? But you don't have to be right you don't require someone to come along and make your dreams come true, right? Make the value, realize the value, because the business will just make money, and it will keep making money over time. And then, the goal is to buy companies that are valued based on their balance sheet, and sell companies based on their earnings, on their income statement, if that makes sense. Yeah. So the goal is you buy a company that's valued based on its book value, and sell the company when it's valued on its earnings,
which should be multiples higher.
Right, that's the goal. And one of the companies I own is called Westaim Corporation, and it's been one of the biggest drags on my portfolio for years. It's an insurer / hedge fund, and it's valued below book value, i.e., the investment that they've made in the hedge fund and the book value of the insurer. And it seems that the insurance company wasn't run very well for years, and that's my fault. I didn't understand how to value insurers correctly. Yeah, I just assumed that you could value, and you could take an average of other insurers that to trading at say 1.2, 1.3, 1.4 times book value, and therefore mine was cheap. Yeah, probably not true. But anyway, when you're a general partner in a hedge fund, you make money by charging other people to manage their money for them, right? Yeah. So in theory, at some point in the future, as the assets of the hedge fund go up, they should start making money on the hedge fund business, which is a really good business. Asset management is a brilliant business. So my thesis is, and it's still my thesis, that as the hedge fund gets more assets under management, they'll make more money. The insurer will eventually make more money, will be valued more highly, and I'll do very well because the company will start being valued at like 10 times earnings as opposed to 1 times book, right? And that may or may not happen. Time will tell. But yeah, it has changed the way I view companies. Completely changed the way I view companies.
So I'm understanding that we're approaching on 2 hours, and you're probably going to need to eat as it's 8 o'clock. And
yes,
I wanted to ask for anyone listening to this that has never invested before but is interested.
Yes.
I'm going to ask for 2 things. 1, a piece of advice that you would give someone to do, and 2, a particular resource that you would point someone towards to begin their sort of knowledge journey.
Yes, good, very good question. And I want to make it absolutely categorically clear that I am not a financial advisor. Oh, I know, but there's 2 sides to this, right? I'm not qualified to give investment advice. Yeah. Even assuming that you have decided to invest. Yes. And on top of that, when it comes to things like tax efficiency, what to do with your own money based on your life situation, i.e. whether you're going to buy a house in 5 years and all that sort of stuff, I'm completely unqualified to talk about that, right?
Absolutely.
But what I can sort of say things that are objectively true, right? And this is they're my opinions about how you should behave, but this is an objective fact, right? One of the things I do is I try and convert cash I earn into assets that I expect to produce income over time as quickly as possible and with a large portion of my income. In fact, almost all of my disposable income I invest it straight away. So I get my paycheck, I invest as much of it as I can afford to invest while being able to eat and buy some, clothes and things.
Sure. Still have fun. Semi-important.
Yeah, but I invest a huge amount of my money every month, a huge portion of my income every month, whatever I can afford to invest as quickly as possible into an asset that I think will earn an income in future. With the goal, essentially, that in a few years' time, and it will take a lot of time, I'm sure, that I'll be earning so much more money from investing than from working, that work is something that I do because I enjoy it, not because I have to do it to survive, right?
Absolutely.
And I think that everyone should aim to be financially independent. And
Yes.
I'm aware that it's not as easy as it is for me, for most people. I'm extremely fortunate to be in the position I'm in. But if you have the choice between buying, the fifth coat or investing some money, maybe investing money is a good idea, right? Or if you, instead of going out 4 times a week and spending in London 50 quid a night on alcohol,
Easy.
investing, right? You invest the money and go out once a week. Yeah. Or, go and play board games with your friends instead of going out to the pub, right?
Yeah.
Same experience, different location, much different prices. I don't know.
Just before you move on to the rest of that point, I think one company that, just again to sort of put this into legitimacy, one company that I believe follows your model is a company like Apple, right? We've already spoken about Apple, but Apple is a company that's continued year on year on year on year to post better earnings, and they've continued to innovate on those things that will then encapsulate the idea that they will continue to go higher in their earnings. So investing in Apple is, I will say it, you won't say it, but I will say it. For me, I like Apple as a stock. I invest in Apple as a stock, and I will continue to invest in Apple as a stock because I believe that as Apple will continue, there's nobody that will chase Apple down so hard that they will be out competed in the Western market, especially. So I will continue to invest.
Well, in fact, the reason Apple is the most valuable company in the world is that they're the only large company, like of the tech companies, that's been able to monetize China.
Yes.
So Google have obviously been banned from China. Facebook's been banned from China. Amazon isn't a thing in China. Netflix isn't a thing in China. What's the other? Microsoft has, I would imagine, to some extent.
Oh, almost.
But,
yeah.
And I own some shares of Microsoft.
Same.
And I think that as more people, I don't know, I wonder how successful they'll be at monetizing individuals in China, but I'd expect businesses to pay for Microsoft products.
I was going to say, I wouldn't. So just to point that out. So this is the value of China, right? So Microsoft obviously own Azure, right? And for those of you that don't know, Azure is a cloud platform that Microsoft have architected and own and run. Microsoft built an entirely separate thing called Azure China.
I did not know that.
Yeah,
I should know that, given that I own the share.
So there's a couple of different versions of Azure, right? One is what you call retail Azure, right? So just anyone could go in, spin up. You could do it if you wanted. Go and spin up some VMs in there, whatever. There's government Azure, right, which has very, very, very strict security standards and dependent on where the data centers are, right? So that's like, let's say you've got the UK government, right? And you just cannot allow any data to ever possibly flow to America, let's just say. Well, there is an Azure built that will allow you all of the same geo-redundancy and all of the same services. However, it is co-located in one place, one data residency. Now, obviously, Microsoft wanted that Chinese money, right? So they were like, how about we just build an entire fucking thing for you? And they were like, sound. So there is Azure China.
Yeah. So, and just to take a mild segue, I'm pretty liberal, socially liberal, generally. I guess I'm reasonably financially conservative, I guess you could say. I think free markets are very useful and good things. I think that you need limits on them, obviously, but I think that generally countries that have allowed for property rights and free markets have done very well. And I think that one of the key things in China's success was was allowing people to own property. Like, you now own this land or this stock or this house or whatever. And the introduction of free markets. One of the things that kind of worries me is that as a Westerner, I think that I follow Western ideals, and the world has become, if you wanted to make money in the last 50 years, right? If every single big company in the world, I feel pretty comfortable saying this, almost every single big company in the world has become big by selling stuff either directly or indirectly to the American middle class.
Mm.
The American middle class is the purchasing engine of the world, right?
Mm.
Like, it doesn't matter what you are. If you're a Japanese company that makes, or like, if you make TVs, you make money selling TVs to the American middle class.
Mm.
If you're, I don't know, financial advising company, right? You make money by advising the American middle class. If you make technology for financial advisors, you're indirectly making money because their business is based on selling stuff to the American middle class.
Mm-hmm.
So and so, like Microsoft Business, while, I mean, you sell the product to the American middle class, you're selling your software to businesses that sell stuff to you get the idea, right? The American middle class is the purchasing engine of the world. And as a result, when you're advertising to the purchasing engine of the world, the type of values that the companies have are entirely defined by the people that they sell to, right? i.e., liberal, left-leaning, in recent years, very woke political views, because that's the view that you have to be able to sell stuff to the American middle class. As the Chinese middle class, which absolutely dwarfs the American middle class in size, it's, you know, what, 4 times bigger or something, 5 times bigger, maybe even 10, I don't know, maybe 10 times bigger. Who knows what the Chinese middle class could become in future. If they have anything like the same GDP per capita as the US, the kind of purchasing gravity of the world will fly across the Pacific Ocean towards China, right? And at the moment, the Chinese middle class don't make the decision about what they are sold. The Chinese government has a yes or no tick box, right? Thumbs up, thumbs down voice on anything that is sold to their own population, right? The NBA has to conform to some things, otherwise they can't sell to the Chinese middle class. Google can't exist, Facebook can't exist, Instagram can't exist, so on, so on, so on. And that, you know, that does concern me, because it suggests to me that companies might go far more towards socially conservative views and so on. It'll be very interesting to see. But yeah, I think that's an interesting thing that might change in the next few years.
100%.
But
100%.
But going back to actually answering the question you asked me before, yeah. Yeah, so I think that people should try and save as much money as they can, but I don't think that's a particularly interesting view. In Britain, I think it's pretty non-controversial to say that ISAs are a very good idea. Stocks and shares ISAs are a very good idea. I use Trading 212. I don't know who you use if you have an ISA.
Free trade.
Yeah, but you can invest, I think it's £20,000 a year. Correct. And then you don't have to pay capital gains tax. And that means that if you sell the stock you've bought in future and it's gone up a lot, I think tax is, I don't know, some percentage of it you have to pay to the government. You can invest £20,000 a year into an ISA without ever having to pay corporate capital gains tax on that money. My view is that you shouldn't buy individual stocks, you should buy indexes. So my view would be the following, very simply, every month you divide £20,000 by 12, and I don't know what that is every month. That's, I don't know what, 1,000, yeah, whatever, right? Whatever amount of money. And you aim to invest that amount a month. And you won't necessarily be able to invest that amount a month, but if it's less, that's fine, right? You work out what you can invest every month, immediately put that money into your ISA as soon as you get it every month. And this is, just to be clear, money you do not need and will not need for the foreseeable future.
So just to chime in, it's £1,666 recurring.
There you go. That's quite a lot of money. That's quite a lot of money to invest every month. Right. Especially if you want to buy a house in a few years. You shouldn't invest money in stocks that you might need to use to buy a house in a few years.
Yes.
Right? Because stocks can halve very, very quickly. And if you're going to buy a house, i.e. if you have a big upcoming expense, you don't want your purchasing power to half right before you're going to buy the house.
Yes.
However, if you're thinking, I'm not going to need to touch this money for 30 years, right? This is saving for my retirement and just making intelligent financial decisions. Stocks are brilliant, right? Because over a really long time span, stocks are likely to have the highest return. And generally, The older you are, the more money you should put in fixed income, bonds, and so on. And the younger you are, the more money you should put in stocks. But I don't want to get into that because I'm not qualified to really comment. I can just say what I do. What I do, and what I would advise doing. Well, I shouldn't say what I would advise doing. What I do, what I think is best for myself, is to buy a global equity index, which is some portion of companies all over the world.
Yeah.
Every month, without fail, you invest the same amount of money. You don't try and time the market because the market's going to go up and down. You have no idea when. You have no idea. You just every month buy a global equity index and do nothing else. And you have to you don't have to spend any time making intelligent financial decisions.
Interesting.
You don't have to worry about it at all. You just trust that people will go to work every day and produce more value than they cost and nothing else. And just
see, I don't do that.
No, I don't do it either. I'm an idiot. I invest. I've started doing it in my ISA essentially.
Right.
But in my own personal account for years, I haven't done that, and I've made far less money buying stupid coal mining companies.
Yeah.
And than I would have made if I just indexed. And it's what I would advise doing.
I'll reiterate what I do. I mean, I have even less experience and even less standing to give my opinion. What I do is I have 2 accounts. Again, in my personal account, I just use it to fuck about with stuff. So for instance, at the start of the pandemic, I put 100 quid in Lyft, right? Because I just decided that Uber in the UK especially was dying. And if it was dying in the UK, it may as well be dying in the US. So I knew that Lyft was a good company. I put money in Lyft. It went up 75%. I was like, oh, that's insane.
I'm a genius.
Yes, I'm a fucking genius. However, to sort of balance that, there's a company called Wrap Technologies. Have you heard of Wrap Technologies?
I haven't.
Wrap Technologies is My Plastic China, right?
Right. Yeah. China XD Plastics.
Exactly.
Yeah.
So Wrap Technologies, just to sort of close this out before we move on to your second question, is it was billed as a revolutionary idea for the police to arrest people safely.
Right.
So if you could imagine, what's the best way to determine this? Do you remember the rulers at school, right? They were made out of that sort of bendy plastic.
Yes.
If you hit it really hard, it would just snap into one thing.
Yes.
Right? So Wrap Technologies was essentially a gun filled with those rulers.
Right.
So you shot it at somebody and it would snap around their limbs.
I see what, yeah.
And only the police would have a key or whatever it was that could unlock that thing. So it made it really difficult to get out of. And obviously it also made it very easy to catch a person because the net would be wide, et cetera, et cetera, et cetera, right? And I was like, oh my God, this is going to revolutionize the way that people are arrested, right? And this was all around the time of sort of George Floyd and these sort of things. And I was like, I tell you what, if this company markets properly, this is going to be absolutely huge. I put money in, and since it's gone down 130%, I was like, oh,
how has it gone down 130%?
Mate, I don't know. It's gone. Like, it's basically gone. It's fucked. The whole thing is dead. My investment itself has gone down 130%.
Oh, did you do it on margin?
Yeah. So
I
just launched myself into the stratosphere of stupidity and came
you went straight on margin. Yeah, that's a bold choice.
And I utterly fucked myself. So I lost all that money, right? So that's the thing. But then in the same vein, like, I've now got an ISA with free trade, and essentially I use that for what I determine to be safe investments, like, as you say, a Microsoft, a Facebook, a Twitter, a this, a that, the next thing. And again, global equity indexes and whatever else is something that I'm going to start putting money into. But yeah, I think it's good in a way to have a personal account where you can fuck about with stuff with arbitrary bits of money that you don't care about, right? Like, put £10 into a company, and if it does really well, you're like, oh, okay, cool. Why did that do well? Work that out. If you do me or you put it into XD Plastic China, or you put it into Wrap Technologies and it fucking falls through the floor, you're like, okay, I'm not going to do that again. But it's something that you can put the money in, and you can be like, oh, okay, well, I'm pissed off I lost £10 because I still lost it off, but it's not something that's going to drastically change the course of your life.
Exactly.
But yeah, sorry, if you can reiterate to the second question, which is a resource that somebody could use.
Yes, sorry, good point. That's a very good question. So the first thing I'd recommend is that can I give you some books?
Of course, go for it. If you give the books at the end of this, I'll list them on Amazon or something.
Yeah. Okay. Yeah. There's a just to sort of shortcut myself. There's a Reddit group, not WallStBets, called Our Security Analysis, and they have a reading list, which I think is probably pretty good. I haven't checked it for a while, but some good sort of introductory books. Liar's Poker is a good one. Just business books, business finance books. Liar's Poker is a sort of classic one. It talks about Solomon Brothers in, I think it's the 1980s. What's it called? Intelligent Investor is a kind of classic book. It was written by a guy called Benjamin Graham and Graham Dodd. What was the other guy's name? I think it's anyway, someone Dodd. Benjamin Graham and someone Dodd. It's a sort of classic book, the classic book that you're supposed to read, but it's a little bit outdated.
Right.
So back in that time, the innovative companies, I don't know if I might be slightly out of date. The innovative companies were very asset heavy. So like say a railroad, for example, has a lot of assets, an oil company has a lot of assets, and it takes assets to produce money. So things like book value were much more meaningful than they are today. Does that make sense? So today, a company like the most valuable companies in the world don't have very many assets at all. Well, Amazon has quite a few assets, but not relative to its market cap, right? Google has basically no assets. Facebook has basically no assets. So a lot of the kind of book value and current ratio and all these ratios that are referenced in the book aren't really as relevant to today's markets as they are to markets then. But it's a sort of interesting idea of the importance of investing versus speculating. But essentially, I think the most important thing is that you have an understanding of like things like the time value of money, which is like $1 today is worth more than $1 in the future, because you can invest the dollar today and then in a year you'll have more money than $1. Just understanding basic principles of finance, I think, are very important. So yeah, I think I can give you a few other books I've read that I think are very good. The Essays of Warren Buffett is a very good book. Do you want me to get them? I can like grab them and.
I tell you what, instead of doing that,
you
find them in your free time, or like after this, whenever you're ready at your own leisure, find them and then let me know the titles, and I'll bang them in the show notes, and that will just be more helpful.
Perfect. And then other things on the internet. There's a really, really active community on Twitter, like Fin Twitter, I think they call it, financial Twitter, which is pretty interesting. I follow a bunch of people on there, which is quite interesting. A really, really big one though, Matt Levine is just brilliant. I can't recommend. It's called Money Stuff. It's like a daily blog, almost daily blog, and it's like really, really complete non-jargon, layman terms, really easy writing. Some of the terms I imagine will be a little bit difficult if you have absolutely no idea about finance at all, but
that's what
you read it for a while. Yeah, exactly. And then there are things like Investopedia, like Googling terms. Investopedia is really good. I still do it all the time. If I don't, I just Google stuff. And but yeah, Matt Levine will give you an idea of what to Google. And he's a very easy, interesting resource to read. But yeah, I can give you a book list as well. That's not
perfect. Well, look, I know that you don't do social media, but I will offer you a chance anyway. If you want to promote your Twitter or anything else where people can get in touch with you, feel free. If you don't, as you shake your head, that's absolutely fine as well.
I don't have any social media. I don't put anything on social media. I'm a lurker.
Yes,
I'm a good lurker. I have social media where I just follow some friends, but I don't put anything out. So no, there's no point in following me.
That's just absolutely fine.
Come and train with me when we're allowed to go outside again. We can go and fight in some sweaty gym. That's the best way to get to know me, really.
All right. Well, phenomenal. Look, I mean, I think that this was really important. And ever since I met you, I wanted to do this just because I think I've learned a lot specifically, right? Just about some of the things that you've been saying. But also I think that especially now where this sort of thing has become so popular, investing has become so popular because of things like WallStreetBets and whatever. And because frankly, some of the fucking bank accounts you can get give you null interest over whatever. So it's useless to put it in. I think that conversations like this with people that just are a little bit more ahead in the chain than the regular man is really, really important. So just from my perspective, I thank you obviously for your time and for your knowledge and for everything else. It's been a pleasure.
Yeah, well, while I don't have any social media, if you have people that want to just chat about it,
yeah,
again, I'm not an expert, but I'm more than happy to do that. So yeah, feel free to
absolutely. Well, look,
set up calls or something.
Take that right. As I said, if people that listen to this want to get in touch with Josh and have any questions, let me know and we can facilitate conversations. But until then, Josh, has been an absolute pleasure. Thank you so much.
Likewise. Thank you very much for having me.